Sorry, guys, I was thrown out of the meeting for some reason. Are you able to hear me now? Cool. Let me request all of you to please switch on your camera and then let's get started with where we left in the last class. Thank you, sir. Waiting for others. Hello, Gauri. Hello, Rishabh. Hi, Ansh. Okay. So in the last class, we talked about, as I said, reading number 41, 42, 43. That's like a broad discussion we had. And we started getting into reading 44, if I remember it correct, right? Did we complete reading number 44 already? No, we started getting into it, I think. So let's go to the individual section and then maybe we'll be able to know where we are. I'm sure we did the market efficiency, weak form of efficiency, semi-strong form of efficiency, and the strong form of efficiency. And what was the key conclusion? What's the kind of efficiency you need in the market? Do you need semi-strong or strong?
Semi-strong,
Why not strong?
because insider information is available, not available for all.
Yeah. So strong form of efficiency would mean that even if you have an insider information, you won't be able to make money. It's not about that you won't be able to make money. The problem is that it means the insider information is available with everyone. And that's not a good sign. So that was like the key take from market efficiency. And I think that what we were doing within market efficiency, there were some sections on behavioral finance and anomalies. I think this is where we stopped and we didn't do this, right? So we did just like touched upon what is an anomaly. Can you recall what is an anomaly from our discussion in the last class? Something which doesn't make sense, right? So if you're married, your spouse doesn't make sense to you. If you're pretty young, maybe your boyfriend or girlfriend doesn't make sense to you. You don't understand, why they behave the way they behave at times, right? So that's like an anomaly. Like, you're not able to make sense of it. Oh, don't get carried away by the example I just gave you. In real market, the biggest anomaly is that you can predict the market. That's the biggest anomaly. Because if you can predict the market and you know that the market is going to go up, or this particular share is going to go up by 3% on this particular day, the point is, why doesn't it go up already? So you being able to predict the market is the biggest anomaly in the world. So I'll stay here and I'll keep repeating that sentence like a few times till you understand the, like the logic behind it. So let's say if you know that something is trading at 100 rupees today, there are so many people who are ready to purchase and sell it for 100 rupees today. When they know that the value of this particular 100 rupees will be worth 105 rupees just after 2 days. My question is, why the hell are you selling it for 100 rupees today when you know that you can sell it after 2 days for 105 rupees? Oh, there could be a financial distress. And that's the reason you just want to sell it out and get money. But how many people will have that financial distress? One people, two people, not like thousands of people, right? But still, I'm saying that everybody's busy buying at 100, everybody's busy selling at 100. People buying at 100 makes sense. But why the hell are people selling it for 100 rupees today when they know that they can sell it for 105 rupees tomorrow? Same thing when you can predict that the prices will go down. So as a buyer, you know that the price will be 96 rupees. Why the hell are you buying it for 100 rupees today? Why don't just wait for one day and buy 4% cheaper? So you being able to predict what's going to happen to a particular share at a particular point of time is the biggest anomaly. You are irrational. But here I'm not just saying like you are irrational, I'm irrational. I'm saying the entire market is irrational. So think about, like everybody knows that the price will be worth 105 rupees after a few days. Okay? There's some stupid people, let's call them stupid, irrational people, who are buying it for 100 and selling it for 100. People buying for 100 makes complete sense to me because they now know that the price will be 105. But my question is, why these people are selling it for 100 when they know that the price will be worth 105 rupees in a day or two? One thing could be there's no surety. There's a there's some chance that the prices can go down as well. But I'm saying that there's a surety. Oh, let me be sure about it. There's nothing called 100% in the market. When I say it will go to 105, means there's a more chance of this going up rather than going down. It means there's more upside than downside. But if there's more upside than downside, wait for a day and get that advantage and sell it for 105. Now, if let's say some people are stupid who are still selling it for 100 rupees, I should take benefit of the stupidity. And even if I don't want to buy the stock, I should buy the stock. The number of people who are buying it are not only the people who are interested, but a person like me as well, who doesn't like the stock, who doesn't understand anything. But I will try to take advantage of this thing that if I can buy the stock today for 100 and sell it after 2 days for 105 rupees, I get 5% return just in 2 days. So the number of buyers in a typical day are generally, let's say there are 1,000 buyers and there are 1,000 sellers. But there are some people called arbitrageurs. The whole purpose of them is to take benefit of these kind of situation. And these people will jump into the market. And these people will jump into the market and will keep buying more and more. So rather than 1,000 buyers, let's say there are 3,000 buyers, but the number of sellers are fixed. So there will be a bidding war. You'll say, hey, I was ready to sell for 100, but there's so many people who wants to buy. Now I want to sell for 101. But because the number of people who wants to buy are so many, you'll keep increasing the prices up till it becomes 104.99. Because at that 104.99, the people who just came into the market to take benefit of that situation will start going away from the market because there's no further benefit left in the price. So ideally, guys, what will happen is even if some people are stupid, these arbitrages will come to take benefit of the situation and they'll make sure that the price goes up to 105 rupees today itself. Understood? But still, if you're able to predict the price going forward, is like kind of, like uh, alien, difficult to explain, difficult to justify, but it still happens. Okay? So with that background, if you understood the meaning of anomaly, there are lots of anomalies in the market. One anomaly is what we call as calendar anomaly. What is a calendar anomaly? Like I'm talking from the context of the US market, where December is the financial year end and January is a financial year start. So generally what will happen is on 31st December, let's say generally the S&P index is, let's say, at 5,000 points, let's say. But on 31st December, generally the index will go down like 1 or 2 percentage point. And on 1st January, generally the index will go up by 1 or 2 percentage point. Somebody's at the door, guys. Give me 1 second. May I request all of you to please switch on your camera? Thank you, Pawan and Ansh. Others, please. Asmita, Nadia, Nandini. Right. Now, what will happen is that why do we see this trend that why the prices go down on 31st December and why the prices go up on 1st January? The reason the prices go down on 31st December and go up on 1st January is very simple. That on 31st December, many people sell their portfolios. Why do they sell their portfolios? Because they want to book their profits or losses, whatever it is. And many times you just want to say, "Arey yaar, it was a bad year. I want to start with a clean slate next year." So there's lots of selling pressure happening on 31st December. And on 1st January, people start buying it back to start with a clean slate, to take advantage of the profit, the tax thing and many other things. Now, the problem is that if this is what is happening in the market, don't you think that there should be a smart set of people who should come into the market and purchase it on 31st December? So there should be a buyer on 31st December and they should become a seller on 1st January. And if they do that, and if there are too many buyers on 31st December to take advantage of this prices going down, the prices won't go down because there are too many buyers in the market. And when you know that there's so many sellers in the market on 1st January, the prices won't go up that much. Prices will remain flat. So the anomaly here is that if you purchase the shares on 31st December and sell it on 1st January, more often than not, you'll make profits. Now, the anomaly here is that not that you'll make profit, that's a good thing. But if everyone knows that you can make profit, why don't people make enough profit that the prices doesn't go down and the prices doesn't go up the next day? So let's say you're selling a flat, right? And you know that today, if you sell the flat, you'll get 1 crore rupees. And if you sell the flat the next day morning, you'll get 1.02 crore rupees. And let's assume that you're in no urgency to sell the house. You're in no urgency of fund. And there's no auspicious day for you or none of those things. Oh, by the way, the word auspicious itself is irrational. Sorry to say that, right? Then you're not thinking rationally. You're thinking in some different manner. Okay? So in this case, if you still say, "Nini, I want to sell the house on today itself. I don't want to wait till tomorrow." I'll be like, "Are you in urgent need of funds?" You say no. "Oh, is this today is a very auspicious day?" You say no. Then I'll say, "Oh, you're irrational." Right? Exactly same thing is happening in the market. That there's an opportunity available that you can buy the stock on 31st December and sell it on 1st January. Not that you'll always make profit, but more often than not, you will make profit. And so many people know about it. There are so many traders, there are so many arbitrageurs sitting in the market to take advantage of it. And still it exists. That's the even bigger anomaly. And when we talk about this auspicious thing, that reminds me of this particular thing called Muhurat trading. I don't know whether we discussed about it already. Did you talk about it? Muhurat trading? Anyone in this room who knows what is Muhurat trading?
It happens on Diwali.
What are you saying? Like Diwali is a holiday, right? And you're saying the markets are open on Diwali?
It happens on the evening of Diwali. It
Or you don't want to celebrate Diwali or what?
happens for like an hour or so.
So or on all the big occasions you have this trading happening, like so on Holi, Christmas Eve.
No, it's a New Year kind of thing in terms of this. So only on Diwali day that used to happen.
Yeah,
No, you are
I have
right.
seen it on Diwali, so I know only Diwali.
No, you are right. It happens only on Diwali, and the market's open for like 45 minutes. Like
Yeah,
what the hell, like why like on such a big festival the markets are opening for people to trade, and it's not opening for the full day. It's just opening for 45 minutes. What's going around? And it's like a real market, right? It's not like it's a dummy market. You can actually buy shares. You can actually sell shares. You can actually make profits. Or you won't find that in your book because India, like, these books are from the US syllabus and they don't understand this, the biggest anomaly we have in the Indian market, Muhurat trading. Why does it happen on Diwali day, guys?
So
Auspicious, I guess.
majority people go for Lakshmi Puja and all things right on the day, immediate day or
Do
so.
puja, burst crackers, enjoy with your family. Why to do trading on this holiday? The markets don't open on 15th of August. The markets doesn't open on 2nd of October. The markets don't open on weekends. But why on Diwali? Is this better, Asmita, now? So, guys, the whole logic of Muhurat trading is that, and the reason it happens on Diwali, it's the uh, worship of goddess Lakshmi, who is like, the goddess of money. And if you don't do trading on that particular day, the whole year will be a waste. जैसे नहीं करते थे पहले स्कूल के अंदर, if you miss your first day in the school, the entire year will be bad, right? So it's that first auspicious day, and that's goddess Lakshmi, the goddess for money. Now the point is that people just don't trade; they trade emotionally, and they don't want to go short. They don't want to be bearish. They don't want to sell because if they sell, they become bearish. You have a negative view on the market, and if you have a negative view at the on the first day of the month, first day of the year, is going to be negative throughout the year. So everybody is busy buying. Now, obviously, when people are buying, there are people selling. Only then you can buy. But there's so many more number of people who wants to buy. There's so many less number of people who wants to sell. And if you see the performance in the market on the Muhurat trading day on those 45 minutes, more often than not, prices go up. So, guys, if you are a rational investor, what you should do is on the day of Muhurat trading, the very first minute you should do is short sell. Sorry, you should buy it the very first minute. And by the end of the Muhurat trading day, sell it. But the prices have gone up by 0.5%, and 0.5% profit is quite a lot in a single day. If you make 0.5% profit in a single day, you make like almost triple the money in a year. And I'll show you what has been the performance of Muhurat day trading in the last few years. Last 10 years of Muhurat trading, see how the markets have performed. Up by 0.2%, up by 0.24%, up by 0.48. And see, there are exceptions. It has been down for like 2 years, up by zero point 0.7, up by 0.49, 0.45, 0.49, 0.88. Such a nice strategy I just gave you. Put all your money in the market. And let's say if you got like 1 crore rupees, you'll have 50,000 rupees at the end of the day. What else do you need? But just don't do it for 1 year, because if you do it for 1 year and what if the prices have gone down? If you keep it doing it over the years, on an average, you will always make money. The anomaly here is that people know it and still people are behaving the way they do. Turn of the month effect, just like not just the turn of the year, people do the same thing on turn of the month. People sell more at the end of the month and buy more at the start of the next month. Day of the week effect, the best day, what is your favorite day in a week? Monday or Friday? Friday, one thing is like it's the end of the week and you must be looking forward to these sessions on CFA, right? So If you are trading on Friday, you could go with a very good mood in the market as a trader, and everything looks very flowery, everything looks very, very good, and you have a positive view about everything, right? But if you go on Monday, oh my God, like another week, and you're grumpy, and not just you're grumpy, but everything looks bad to you. So you go with such a bearish view in the market. So generally, there's a tendency for the markets to go up on Friday and for the markets to go down on Mondays. So what is the anomaly here? People can take advantage of it, that you should buy the shares on Monday when the markets are down and sell it on Friday when the markets are up. There's a holiday effect. Generally, like if you see in the UK and US region, like July and August is like a summer holidays, right? And think about, let's say, the summer holidays, and that's completely aligned with your kids' holidays, the school holidays. So let's say there are school holidays starting from second week of August. You know what? The first week of August, the markets will always do better. So you just booked your ticket to go to California with your family for a trip, and you booked a nice five-star hotel and a trip to a casino, and you're also doing trading in the market. Think about your mindset, think about your sentiment. They'll always be positive, right? So that's called the holiday effect, that the market always give higher return just before the holidays. Sorry, let me not say the word always. More often than not, they give you positive return just ahead of the holidays. Now there's something called overreaction and momentum anomalies. What is an overreaction anomaly? It says that whenever there's a news in the market, generally people overreact. So let's say because of a news in the market, the stock price should go up by 3%. But there's a tendency that the stock will overreact. So when people hear about the news, rather than prices going up by 3%, prices will go up by more than 3%. Now, if the market has overreacted, it has to normalize, right? It has to come back. So in this case, when you know that the markets are overreacting, what you can do is wait for the news to come in. And if it's a positive news, wait for 5-10 minutes. And after 5-10 minutes, short the stock. Because people would have overreacted and there's a tendency for the prices to go down. And if it's a negative news, let's say the prices should fall by 3%, but the markets will overreact. So in this case, if it's a bad news, you should buy the stock after a few minutes, because market would have overreacted on that bad news and there's a tendency for the prices to go up. So it sounds very counterintuitive, that buy if it's a good news, sorry, buy if it's a bad news, because market would have overreacted on the other side, and sell it when it's a good news. Why? Because market would have overreacted on the upside. So this is what we call as overreaction effect. Momentum effect is the same thing, like something which has gone up in the last few months generally keeps going up, and something which has come down in the last few months keeps coming down. So buy what has gone up and sell what has gone down. And this way, like, many people make profit. So one of my friend, his entire strategy is momentum strategy. He doesn't do any research, nothing. He just look at the stock which has gone up continuously for the last 2 or 3 days. He buys those shares. If the rally continues, he's just like flying. But he has got a rule. If the rally doesn't continue and the price starts falling, he sell it and makes a stop loss at 10%. So he'll lose 10%, but sometimes his money will become double, triple, and 4 times. The size effect. What is the size effect? Let's say if you want to invest money in a large company like Reliance Industries or HDFC Bank, versus you to invest money in a, let's say, very small company XYZ. If you're getting, let's say, 12% return by investing into Reliance Industries and HDFC Bank, are you happy with the same 12% return by investing in a smaller company? You want more, right? Why? Because given it's a smaller company, the risk is more. What kind of risk? That this company can go bankrupt. I can't imagine Reliance Industries going bankrupt. Because this company is small company, maybe they can be acquired, they can, like there could be a competition which is much higher than these people, right? But can somebody pose a competition to Reliance Industries? Very difficult. So as a result, if you're getting 12% in Reliance Industries, maybe with XYZ, I need a 15% return. So guys, if you get a higher return with a smaller stock like XYZ compared to 12% in Reliance Industries, is that an anomaly? No, that's very logical. But the point here is that the smaller companies gives you a return which is just not more than 12%, but which is also more than 15%. So the small size companies gives you a return which exceeds the return what you should get even after adjusting the risk. So rather than 12, you should get 15. If you get 15, that's not like you're getting extra. You're getting extra because of the risk you're taking. But if you get even more than 15, that's like an additional return you're getting, but the risk is not that high. And that's an anomaly. So the small size companies gives you a much higher return even after adjusting for the risk. Again, I'll repeat, if you're getting more than 12%, that's not an anomaly, but you're getting more than 15%, that's an anomaly. There's a value effect. What is a value effect? There are two types of stock. One is value stock. The other is growth stock. What are value stock? These are the stocks you buy because they're available cheap. And the growth stock, the reason you buy, they're not available cheap, but you still buy it because you see lots of potential in terms of growth from these shares going forward. Now, obviously, the growth stocks will be expensive. And obviously, these are cheap. So these value stocks generally outperform the market. Now, you like that's obvious, right? They will outperform the market. But guys, they're cheap for a reason. They're not that good stock. And they're expensive for a reason because they're really good. But still, though there's a reason behind they being cheap and there's a reason behind they being expensive, but these stocks does better in terms of share price performance, and that's an anomaly. There's a closed-end fund versus an open-ended fund. What is a closed-end fund? Where you invest your money, but your money is stuck. You cannot take the money out for the next couple of years. That's a closed end. In case of open end, you can go in, go out at any point of time. Now, technically, if you're a long-term investor, if you can buy a closed-end fund, let's say that's available at a discount of 2 or 3%, that should be worth, right? You don't care about the liquidity. So the closed-end fund have the same ownership as an open-ended fund, but just because it's closed-end, it's available at a discount, and the discount doesn't make sense. That could be an anomaly. Earnings announcement. Just give me 1 second. Huh. So what is there in earnings announcement is exactly opposite of the overreaction bias. Overreaction में क्या हो रहा था? That if there's a positive information, and because of that positive information, the stock price should have gone up by, let's say, 3%. What was happening in overreaction bias is that the prices were going up by more than 3%, and there was a tendency for the prices to go down. But in case of an earnings surprise, it's the other way around. Let's say there's a positive news coming to the market, and in an ideal situation, the prices should go up by 3%. But the market is a bit slow to react. It goes up, but it takes maybe a day, 2 days, or maybe a few days before the market price goes up to 3%. In case of overreaction, you are overhyped. In case of earnings announcement or earnings surprise, in this case, you're a bit lazy. Not lazy, but you're just taking time to understand. You're taking time to reflect in the market. You're taking time to put the trade in the market. So in case of earnings announcement or an earnings surprise anomaly, if there's a positive news, buy the stock. Why? Because the market would not have gone up to the full extent. And if there's a negative news and the market price should fall to this level, it doesn't fall quickly. It takes time for the prices to go down. So if it's a negative news, sell the stock immediately because you'll be able to still get out when the prices have not fallen enough. So guys, an ideal situation would be that if there's a positive news, the market price goes up by 3%. But what happens in overreaction bias? Prices go up, but they go up a lot. So there's a tendency for the prices to come down. And what happens in case of earnings announcement bias? That the prices have gone up, but not enough. So there's a further tendency for the prices to go up. So the green is what is the very, very idealistic scenario. But in case of overreaction bias, what happens is the red component, it goes up too much. So you should short the stock. And in case of earnings announcement, it's the orange line that it has not gone enough. So you should buy the stock to take advantage of the prices going up. But at the end of the day, in all the three cases, the stock price will close 3% higher. Another anomaly is initial public offering that generally at the time of IPO, the stocks are available cheap. And as a result, if you keep investing in IPOs, you'll always make more money than the money you make in the market. So guys, but the point is if everybody knows that there's an extra money available in IPOs, people should oversubscribe. Oh, that started happening in India, but still there's a room left. Now that's one thing, guys. Second thing is behavioral finance, how people behave. So if you want to become a portfolio manager, it's good thing that you know hypothesis testing, you know probability, you know the quants, economics, equity investment, fixed income, and all of it. But it's also very, very important that you understand how people behave because you're not managing people. You're not just managing robots' money. You're managing people's money. And there's a saying in the market that if you have got 100 clients whose money you are managing, the total number of people you manage in a year is equal to 20,000 people. Any idea what is the logic behind it? There are 100 clients whose money you are managing, but in a year you deal with 20,000 different people. Why will you deal with 20,000 different people when you got only 100 clients?
Prospective client.
No, like, is your conversion so bad that you just convert 0.5% of the clients? No. I'm like very happy with 100 clients. I don't have even marketing. I don't do any advertising. I don't even entertain new people because I don't have the bandwidth. But I still deal with 20,000 people. What are we missing here? How will I deal with 20,000 people, guys?
For research purposes.
Yeah, maybe like I look forward to like, a few analysts, like 10, 15, 20 analysts who I deal on a daily basis. But 20,000,
For every client asks question on market day. That's why.
yeah, they ask question, but still like, okay, if you ask me question now, like, and you ask me question in the last class, I'm still dealing with Ansh, right? You are same as a person.
First, sir, but sometimes they are optimistic, sometimes they are pessimistic.
Absolutely. So this is a CFA class and Ansh as a person remains same, whether it's an equity investment class or a fixed income class. But let's say if he's an investor and I'm his portfolio manager, if the markets are going up, he's a different person. When the markets are going down, he's a different person altogether, right? So that way you are dealing each day, each client behave differently. So there are roughly 200 working days in the year when the market, the portfolio manager actually work. And because each people behave differently in each of the day, he's technically dealing with 200 different Ansh in a year, dealing with 200 different Pavans in a year, 200 different Rishabs in a year, and so on. Okay? So guys, it's very important that you understand how people behave, because if you don't, you are just completely going to be a loser as a portfolio manager. So what are the behavioral finances and what you should understand? One is loss aversion bias. These are very important, and trust me, like I've seen it like in with so many people. And the biggest example of a loss aversion bias is with my father. So I started doing a job in 2007, guys. I don't know whether I talked about it before in the previous classes. Did I? My journey in the initial years, like 2007.
No.
What is it like? What's the feel you get when I say the year 2007? What's so particular about year 2007?
Crisis.
Recession
Lehman.
period.
Crisis happened in 2008 and 9.
Yeah.
2007 was like the best year people have seen. So guys, there's a thing, right? And don't tell it outside people people outside this room. But anybody who started making their career in 2007, they just got lucky. They're actually the losers. The reason they could make their, like the career in investment banking is because the industry was so good. If you made your career, if you made your first job in investment banking world in 2009, you must be the cream. But to make a career and to start your career in investment banking in 2007 just required you being a human being. You have some finance degree and you can just do like some finance work. That's it. So, you know, the only thing is like I couldn't take advantage of this entire up and down because it's just like too early and maybe I didn't have enough guts. But my father was like always after my life in 2007. Hey, you have become an equity research analyst. You should tell me like what I should buy. I'm like, since when did you start investing? And it'll be like, no, like I don't invest, but like neighbors were telling that they invested 30,000 rupees, and within 1 month, this 30,000 has become 40,000 rupees. And guys, like 20 years back, like that used to be a big amount, right? So he kept asking me, and at one point of time, he got very desperate because the point is that there's something called FOMO. Gen Z has a different kind of a FOMO. Like they don't want to miss out any parties, they don't want to miss out any gossip. But the FOMO in the market, like you don't want to miss out the rally, right? And when everybody is making profit and you're not making profit, technically you're a loser. Though you didn't lose anything, but related to others, you are a loser, right? So in this case, what happened was that the share markets were going up. And guys, the rally was so fascinating that every day it felt like if you did not invest yesterday, you lost quite a lot, right? Because the rally was coming from the bottom and it was just like going up and up and up, like very steep increase. And my father kept asking me, should I buy? I'm like, I don't know, but people are thinking that the markets are heated. But within a month, market will go up by another 10%. My father like, you got it wrong. Should I invest it now? No. The markets were heated. Now the markets are overheated. My father like, should I invest now? Well, no, never. The markets go up further up. So at one point of time, he said, you know what? I don't trust you. I'll make my own decision. I'll invest money in the market. And he invested 1 lakh rupees at that point of time. So he closed his LIC policy, took the money out, paid the fines, and he invested the money in the market. And I asked him, okay, what's your horizon? Like, what do you want to do? He said, this, I've invested in 1 lakh rupees. I won't be greedy. Uh, as soon as it becomes 2 lakh rupees, I'll sell the stocks. And I'll be like, okay, like for how long you think you'll be investing for? And like, the way the markets are going up, maybe my 1 lakh rupees will become 2 lakh rupees within 6 to 12 months. And this is when I'll sell it. And guys, my father got it so right, got it so wrong that he invested right at the peak and the market started crashing. And this crash was such a huge crash that nobody had seen before. And it's just not like the markets crashed, but it remained at a very low level before it started going up slightly over the years. After 2 years, I asked him, okay, what's the situation? Like, did you sell the stocks? Now, I knew that, he gets a bit picky when I ask him about his portfolio. He'll be like, his language, his tone will change. He'll become very, very grumpy. So I stopped asking him. But one fine day, and that happened sometime in 2022, I think, that he called me very excited. And I'm like, what? What happened? He said, you know what? I sold what I bought in 2007 finally at a profit. So he sold it at 1.01 lakh rupees. And he was very, very particular about that I made 1,000 rupees. And I said, okay, 15 years, you invested your money. If you had invested this money in a fixed deposit scheme, your money would have become 3 times. If you had invested this money in a particular land, that would have become 10 times. So are you excited about this 1,000 rupees? But he was like, no, I don't care. But just like I didn't make a wrong decision. See, I made a profit. So guys, this is what we call as loss aversion. You don't want to book losses. Because see, whether he wants to accept it or not, he made a mistake. But if he would have sold it here, he's kind of admitting his mistake. And admitting mistake is a crime, right? So just like admitting mistake is a crime, booking a loss is also a crime. And you want to avoid booking losses. And this is what we call as loss aversion. Because think about if you bought a stock at 1,000 rupees thinking it'll go up, but it goes down. It means you made a wrong decision. Sell it off. But what you do is, no, I'll keep it. It goes further down. Again, second warning, sell it off. It gives further down. You're not sold it yet. Last warning, sell it down, sell it off. But if you don't sell it off, it keeps going down. Your losses keep getting wider and wider. And what's the behavior playing out here? That you're just not comfortable booking losses. Because once you book losses, you put a stamp that you made a wrong decision. But do you want to accept it? No, you don't want to accept it. Okay. So welcome to the way people behave. And the first thing which is very, very important in the financial world is loss aversion bias. The second important one is investor overconfidence. People like me are more exposed to this overconfidence bias. I think we discussed in the previous classes that generally we think that we know everything. We think that we know better than others. And it's not about, I think that I know it. The problem is that I think that you don't know it. And as a result, I think that, I'll be able to beat you in the market. Why? Because I've done my CFA, I've done my MBA, I've done my equity research. Oh, but all the smart investors, by the way, does not have any of these degrees. And still they do so much better in the market, right? So this is what we call as overconfidence bias. Another bias is herding behavior, like people just follow others blindly. Did I tell you about this unearned thing? This particular, nope. Oh, this is very, very close to my heart, like this entire incident. So the setup is like this, I go to my hometown and one of my friends, he operates like a terminal, like he has got like a nice small setup. He's got his clients, but he's not like a portfolio manager. He's just like trading and making commissions when people trade through him. And who are his clients? His clients are, like old people, like who are 60 plus, 70 plus, who doesn't have anything to do. They're retired people. Not very rich people because all the rich people do their own trading. So maybe like a slightly lower middle income class people smoking bidis rather than smoking cigarettes. And because they're so jobless, they are just like sitting around my friend. So like, my friend is sitting here, there are lots of plastic chairs. And like if you want to trade, you can call on the phone and give him the trade. But they will be just sitting around there, just chatting, smoking bidi, having tea, gossiping, and all of it. So it's just like a very nice place if you want to understand, how people behave in the market, how people think in the market. Not like the portfolio manager, but like a typical retail investor. So one day I was sitting there and one person come running. And think about like a 75-year-old coming running. Must be he's got a very big insider information, right? He comes and tell my friend that can you buy an unsund share? I don't know how to spell it in English. There's no English word, but do you know what is unsund like in Hindi? Have you heard this word unsund? कुछ भी unsund बोल रहा है यार ये तो random, right? So my friend listens to him and he just go and buy a particular share in the market. And you won't believe me, guys, but like second person comes running. भैया भैया unsund खरीद दो. My friend again goes and buy the same share in the market. And this happens, and then there's like a group of people coming and running. Bhai ji, unsund kharid do. Like just buy unsund. But every time my friend is just not buying any random stock. He's just buying that particular stock. So after things calm down, I asked like my friend, why do you just keep buying this particular stock? He said, no, this is what all these people are saying. I said, no, these people are not telling you to buy any specific one. They're telling you to buy any random stock, unsund stock, right? No. They're asking me to buy Indocent, and that's what exactly I'm doing. So guys, what is happening is these people who are buying unsund stock, they would have heard it from somewhere कि Indocent Bank is a good company to invest into. अच्छा उसका revenues क्या है, growth क्या है, वो तो छोड़ो. कंपनी बैंक है या एफएमसीजी कंपनी है या वो टेलीकॉम टावर्स है, वो भी छोड़ो. कंपनी का नाम भी नहीं पता उनको. पर हाँ, अनसन खरीदना है with the kind of urgency, with the kind of passion. And somebody is saying कि भैया मेरा बाकी सब जो पोर्टफोलियो बेच के पूरा अनसन खरीद दो. क्यों? कहीं कहीं पे उन्होंने सुन लिया है कि इंडस्ट्रियल शेयर प्राइस विल गो अप. This like a typical herding behavior. Now, I don't have a problem with the herding behavior, but the problem here is that if too many people start going for the herding behavior, the market becomes overheated, and then there's a more chance of a bubble getting created. And all of us know what happens when the bubble bursts. What happened in 2008 and 9. Okay? So that's the reason at the start of the class I was asking you that how do you, like do the transaction, or that's based on a tip. But the person who initiated the tip had bought his own shares in the market and has started spreading the tip. And as a result, when more and more people trade on it, the prices keep going up. At some point of time, the person who originated the tip will withdraw the money, and only people who are left in the market are part of the bubble. And when the bubble bursts, everything will fall from a height, but the person who is already exited doesn't care about it. So that's your herding behavior. So guys, it's a very interesting topic, and by the time you get into level 3, this topic will become bigger and better. So I love level 3 because it covers lots of anomalies, lots of behavioral finance, how people behave, and these kind of things. Okay, so that was about the last topic. Now this is the point of time we'll actually get into equity investment as a topic. So I told you, right, 41, 42, 43, they are also part of equity investment, but they just covered general market. And we start focusing on equity investment only from reading number 44. Okay? So let's take a break. It's 10:26. We'll be back at 10:45, and then we'll continue discussing about reading number 44. Okay, guys, let's get started with the overview of equity securities. Let me know when you're back. May I request all of you to come on your cameras, please? Okay, so they are getting into equity investment. The shares can be common shares or the preference shares. Common shares are the ones where they people take the actual risk associated with the company. So if the company incurs losses, they are the people who lose the money first. But guys, if the company does really good, these are the people who will benefit the most. So common shareholders are the real owners in the company. They have the voting rights. And when we talk about voting rights, they can vote on some of the important matters in the company. There are two types of voting. One is statutory voting and the other one is cumulative voting. Think about in case of a statutory voting, how does it work? Let's say the company has got total 300 crore shares. Out of those 300 crore shares, let's say you have got 3 crore shares. So technically you are 1% owner in the company, right? And let's say the voting is about who should be the next director out of 3 available options. So in case of a statutory voting, how does it work is each share will get one vote. So the total 300 crore shares, there'll be 300 crore votes, and you will get 3 crore votes out of it. So technically, each share equal to one vote, and your number of vote will be equal to 1%. In case of cumulative voting, let's say there are 4 people who are eligible for that post, and the voting is about who should be chosen. Each share will be given multiplied by 4 shares, votes. So if you got one share, you'll get 4 votes. So as a result, the total number of votes in the company would not be 300, but the total number of votes will be equal to 1200. But in that case, you will also not have 3 crore votes. You'll also have 12 crore votes. Now, guys, it's one and the same thing. Whether you have 3 out of 300 or 12 out of 1200 is 1%. But generally, in case of cumulative voting, because the number of votes are more, it's good for the small shareholders. So this second part is what we call as cumulative voting, where you get the number of votes to be multiple of number of shares. See, cumulative voting makes it possible for a minority shareholder to have more proportional representation on the board. Mathematically, it's same, but then you get more. Like, let's say if I just got one share, and if I want to choose like more than one person, can I do that in case of statutory voting? No. But in case of cumulative voting with one share, I'll get 4 votes. I can give 3 votes to person A and 1 vote to person B or something of that sort. Besides common shares, it could be preference shares. They get a preference. In case of a company goes bankrupt, they will get their money first. In case the company does not have enough money to give dividend, they'll get a preference to get dividend. But obviously, guys, because they get preference, they are not the true owners in the company, right? So if the company is really good, they don't have an upside, but their downside is also limited. In this case, within preference shares, it could be cumulative preference shares or non-cumulative preference shares. What are cumulative preference shares? Let's say you invested 1,000 rupees in my company and I have to give you a dividend of 20 rupees every year. Let's say last year for because of the some reason I couldn't give you dividend. So next year, before I give dividend to the common shareholders, I should give you the dividend for the last year and the dividend for this year. If I don't give you dividend for the last 4 years continuously, in the fifth year, I should give you 20 into 5, 100 rupees ka dividend before I go and give any money to the equity shareholders. So this is what we call as cumulative preference shares. In case of non-cumulative preference shares, if I missed your dividend in last year, this year again, I should give you the dividend for this year before I give the dividend to the equity shareholders, common shareholders. But is it cumulative? Do I have to give you the dividend for the last year? No. Once you lost it, you lost it. So that's called non-cumulative preference shares. Which one is better, cumulative or non-cumulative for you as an investor?
Cumulative only.
Yes, but they
Yes.
will be available expensive as well.
Right.
Right? The preference shares can be participating or non-participating. What is participating? As I told you, let's say if the company does really good and the prices of the share has gone up quite a lot, does the preference shares holders get any stake in it? Does get any share in it? No. But in this case, participating preference shares would mean that obviously whatever the money is left is for the common shareholders, but they will also get some share in it if the company becomes very, very big. So it could be like, if the company makes a profit of 100 crore rupees, if the profit goes up to 500 crore rupees, preference shareholders won't get anything. But if the profit crosses more than 500 crore rupees, maybe they'll get some share into it. So this is what we call as participating preference shares. Non-participating preference shares doesn't matter how good the company does. The company will pay you only the fixed amount. So that's called non-participating. Which one is better, participating or non-participating? Participating. But the only thing is this will be available expensive as well. The stock could be convertible or non-convertible. Convertible preference shares would mean that if the shareholder want, they can convert it into the common shares. Remember we discussed this in case of fixed income as well, convertible debt holders. Similarly, there is a convertible preference shareholder. If they want, they can convert it into common shares. Non-convertible means they cannot be converted. Which one is better, convertible or non-convertible?
Convertible.
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 So guys, a convertible participating cumulative preference share is better than the one which is non-convertible, non-participating and non-cumulative. But before you get too excited, the one which is convertible, participating and cumulative will be much more expensive in the terms of price you pay and will be much lower in the terms of dividend you get compared to another share which is non-convertible, non-participating, non-cumulative. Within common shares, there could be class A and class B. What is class A and class B? Generally, class A is considered to be a higher class and class B is considered to be a lower class. So what these founders and all this, the initial large shareholders do, they will issue the shares in the market, but they will say that, okay, class A, I have got only 100 shares. And what I'm issuing in the market is 1,000 shares or 900 shares. So somebody will think that the founder is keeping only 10% stake because they're keeping only 100 out of 1,000. So the total is 1,000, of which 100 is class A, which is left with founder, and the 900 is with like the outside market. And somebody would think that because the owners have invested 100 out of 1,000, they have only 10% ownership. Yes, they have only 10% ownership because they have divested the remaining 90% to other people in the market, and they have only 10% stake in the company. So whatever profit the company makes, the shareholder, these people will get 10%, these people will get the remaining 90%. But when it comes to voting, class A might have a different voting right compared to class B. So many times class A shareholders will say, you know what, for every one share I hold, my total voting is equal to 10. For each one share, I'll get 10 votes. But for class B, each one share will get one vote. And if you do the math, guys, though they have only 100 shares, each share will be worth 10 votes. So the total number of votes they will have is 1000. Total votes number of votes class B will have is 900. The total number of votes the company will have is 1900. And class A will have 1000 out of 1900, which is equal to 52 or 53% ownership. So technically, though they have only 10% ownership, but they have a 53% voting right. So read with me. One class may have greater voting power and seniority if the firm's assets are liquidated. As a result, though they have only 10%, but they are much safer and they have a much more voting rights. The companies can be public or a private equity. Public means it's listed in the market, there are too many buyers and sellers. Private equity, the example could be like, let's say my family business, right? How many people have invested in the family business? Only we people, like who are part of the family. How many people who are interested to buy? I would say zero. And how many people are who are ready to sell the stake? At this stage, I would say zero, right? So the number of buyers and sellers are limited. Nobody wants to buy a stake. Nobody wants to sell a stake in these businesses. As a result, they are very, very liquid. But let's not take an example of my family business. Let's take an example of a slightly bigger company. Let's say Zomato before it went for an IPO, right? Even before Zomato went for an IPO, there were too many investors, right, in the company. But was it easy for us as a retail investor to take a stake in the company? No. We had to approach another fund who have invested in Zomato, right? A private equity fund who would have invested in Zomato to take a stake from them. So it's not very easy to trade in private equity. They're less liquid. Share price is negotiated between the firm and its investors. So if I want to stake in Zomato, I have to reach out to the Zomato founder and say, hey, I'm looking about buying a 2% stake in the company. Zomato founder can say no to it. And guys, that 2% stake will be worth a few thousand crore rupees. So, like only the large people will be part of this game. More limited firm financial disclosure. Only when Zomato becomes a publicly listed company, only then they have to report their financial statements, income statement, balance sheet, cash flow, annual report. But when they're private equity, is there any requirement? No, there's no requirement. The corporate governance is weak. Like, how they tackle the accounting thing, how they tackle the board of directors, how they tackle many other things is very weak because they don't have too many eyes on them and they do not have to follow all the rules and regulations what are applicable for a publicly limited company. Potentially greater return for investors once the firm goes public. Because when the firm goes public, the number of people who will be interested in the company are just too many. And as a result, the people who invested in the company at a starting stage, when the company was private, they make lots of money. Venture capital, like these are the people, like, these are the companies which are in a very, very early stage. And when I say venture, it's like could be as early as just like the idea stage. I'm planning to start my own venture where I'll be doing this. Have I started doing it? No. And on this idea, if you like my idea and you're ready to invest, and if this idea works out, so let's say if Zomato came out with an idea like, let's start with a food delivery e-commerce thing. At that stage, if somebody would have invested 1 crore rupees in that idea, trust me, that 1 crore rupees would have become a few thousand crore rupees. Because with 1 crore rupees in that idea, let's say if you had that idea, you were the founder, and if I say, I love the idea, here, take my 1 crore rupees. Don't you think for that, just for an idea, if somebody is ready to bet 1 crore rupees, you'll be ready to give 20, 30, 40% ownership in the company? And think about what is the market cap for Zomato today. Now, there's something called leverage buyout and a management buyout. What is a leverage buyout? Many times, and this guys will discuss more when we get into alternative investment, because this is where it's covered in a lot more detail. In case of a leverage buyout, let's say Gauri started her own venture. Okay. And what has like how her balance sheet looks like today is that she has got total assets worth 800, and in terms of liabilities she has got her own money invested in the business, whether in the form of profit or what she initially invested is equal to 700, and she has taken a loan or the liability worth 100. Now she wants to grow the business to the next stage. So what she's doing currently is she's doing like completely online. It's like, let's say, retail outlets, retail business. So she's doing it online. But now she wants to come out with her own franchisee stores. She wants to start doing more marketing. But for that, she needs lots of money. And we're just not talking about like 30, 40 crore rupees. We're talking about like a few thousand crore rupees. So think about Gori goes to a bank and say, hey, I need a loan. They'll say, yes, like you got lots of assets. We can give you a loan of another 100 crore rupees, 200 crore rupees. But Gori say, no, 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 I want 1,000 crore rupees. The bank will say, but you don't have enough assets to take that much loan. So as a result, maybe Gauri as a founder does a tremendous job to get this startup to this level, and it's completely like she did not sell her stake to anyone. She just grew by her own money, and she has got the business which is now 800 crore rupees. But now she's stuck. Like she cannot take it to the next level because to take it to the next level, she needs money, and she does not have enough money. So what a typical thing will happen is a private equity fund investor will come and target these kind of companies. Why this is a very good target for a private equity fund investor? They will tell Gauri, you know what? Your business is worth 800 crore rupees. We are ready to give you 800 crore rupees and you can get out of it. Gauri will be like, yeah, like I've done my best and I'm very happy with 800 crore rupees. That's more than happy for my retirement. So what the private equity fund will do is they will buy out the company, which is 800 crore rupees. They have to pay 800 crore rupees, right? 700 crore rupees to Gauri herself and 100 crore rupees to the people from whom Gauri has taken the money. Now that's technically whose liability? That's the liability of a private equity fund, right? So in this case, what the private equity fund will do is private equity fund will go to a bank and say, to acquire this company, Gauri's company, I need some money. So the same bank said no to Gauri for her own business. But now this bank will be saying, Acha, you need a loan. And who am I? I'm one of the large private equity fund investor, has got lots of goodwill in the market, is being known for investing huge amount of capital, and I've got lots of goodwill in the market. So bank will say, yeah, yeah, why not? We are ready to give you a loan worth 600 crore rupees or 700 crore rupees. So I take a loan of 700 crore rupees, take my own 100 crore rupees, pay out these people. So technically, I got the business worth 800 crore rupees by only investing 100 crore rupees in the business. And if I want to grow further, it'll be very easy for me to take further loan from the bank. So this is what we call as leveraged buyout, that I'm taking a leverage to buy out another company. But the important point here is that to do a leverage buyout, I want to make sure that the current leverage is not that much. So if Gauri had already taken a loan which was equal to 700 crore rupees and her own money was only 100 crore rupees, तो इसमें leverage buyout करके क्या करूंगा मैं? मतलब Gauri has only taken the leverage she could take. So for me as a private equity fund investor, my whole value add here is that I can take the leverage, I can take the loan which Gauri couldn't. So my target is those companies which does not have a high leverage currently. And I can acquire these companies by taking a huge debt and investing only a small part of my own investment in the company. Okay? So this entire thing is called leverage buyout. Investors buy all of a firm's equity using debt financing. If the buyers are the firm's current, okay. Now in this case, rather than a private equity fund investor buying this company, the existing management of the company buys the company. The company CEO and the CFO buys the company. Why? Because they know the potential, they know very good about the company. So Gauri is just the founder, but let's say the company is being managed by Rishabh and Nandini as the CEO and the CFO. So what Nandini and Rishabh will do is they will go to Gauri and say, you know what, we want to buy the company if you want to sell it. Okay. So this is technically leveraged buyout and the management buyout. And guys, this new thing which came up very common, PIPE, private investment in public equity. This became very common and it was like the limelight in 2021, 22, 23. Now it has died down quite a lot. But what is PIPE in this case? Let's say I'm a fund. Sorry, let's say I'm a person who is very well known. And guys, I'll just throw a name here. Bill Ackman. He's actually the person who is behind this entire PIPE thing. So he's like very famous. He's a very large investor. And if Bill Ackman wants to invest money somewhere, there'll be a line of people who'll be ready to give him the money to get invested in the market, right? So let's say Bill Ackman says, you know what? I really think that this particular tech company is available very cheap, which is listed in the market. I want to buy out the entire company. These are the things like this guy does, by the way, right? But obviously, like he's rich, but he's not that rich that he. And even if he's that rich, he doesn't want to invest all his money into buying that company out, right? So what he does is that he just go and get the money from public. So what he'll say is, okay, let's create a fund, and that fund itself is private because that's not like listed in the market. And the fund money I'll use to buy out this company which is available cheap in the market. But guys, the point is that the tech company is available cheap today. And if I start creating a fund, do all the paperwork, do all the legal work, this will take me lots of time, right? And by that time, the opportunity may slip. So in case of PIPE or private investment in a public equity, what I do is me as a Bill Ackman or me as an investor, I'll come to you guys and say, you know what? I'm creating a company. I'm creating a fund. And in this fund, I need 1 crore rupees from all the people, and I'm looking for 10,000 investors. So the total fund size will be equal to 10,000 crore rupees. You'll be like, what the company will do? I'll say, I have no idea. It's a blank check company. There's no business. The company does nothing. But what is the objective of the company going forward? Going forward, the company will look out for the public equity companies which are available cheap. And once the company buys that public equity company, technically you become the owner in that public equity company. But by creating this blank check company, it's a blank shell company, there's no business currently of this company, and you're giving this money only entirely on my trust. And I'm not going to just use this money for making a nice swimming pool in my house. I'm going the requirement is that I'll park this money in a particular bank account as an escrow account and use this money only when I have to acquire another business. So guys, this is what we call as pipe. They are also call it SPAC. So I think pipe and SPAC are one and the same thing. Huh. SPAC. So SPAC is like I think around the same thing. You can read about it, but guys, the only thing is this thing was very prevalent a couple of years back. Now not many people are talking about it. Foreign equities, it's very important that people can invest into foreign markets and foreigners can invest into the domestic markets, but this will make sure that the markets are very free. When capital flows freely across borders, markets are said to be integrated. An increasing number of countries have dropped foreign capital restriction. So even in case of India, if I recall, this FDI thing, right? Direct investing and FII. Direct investing में कोई problem नहीं. FII जो investors वाले जो पैसा है, like what you invest in the share markets and all, there used to be a restriction that you cannot put more than this much money in this particular sector. But those restrictions have come down a lot. Like I can just Google and can show you FII. I think in defense they have removed the FII limit in defense sector increased. So see, it was enhanced up to 74%. I think the limit was 24% for the foreign investors to invest money, but now they can invest up to 74%. And guys, by the way, these are very magical numbers: 24%, 26%, 74%, 76%, 49%, 51%. Any idea what's so magical about these numbers? The article we read, it mentioned 74%, right? Why not 75%? Why not 76%? Why 74? So these are magical numbers: 24, 26, 49, 51, 74, 76. Can anybody tell me what's so magical about it?
Holding majority with them only, whoever is proposing it.
But the majority is 50, right? So if you have 49, yes, you do not have the majority. If you have 51, you have the majority. So I agree with these two numbers.
Mhm.
But what is the logic of 24, 26, 74, 76? Okay, so guys, generally what happens is, like, whenever you vote, either you require a simple majority, which is 50%. Sometimes you need a special majority for some of the resolutions. And for special majority, you need 75% vote. So if you got 51% or 74%, it means that in both the cases, you have enough to have a simple majority to be won, but you cannot win the special majority by yourself. But if you got 76%, not only the simple majority, but even the special majority is in your hand. If you got 26%, nothing can be passed which requires a special majority without your permission. But if you got 24%, not only the simple majority, but even the special majority can be passed even if you do not vote in favor of it. So in case of defense sector of India, let's say, like all the important decisions which can impact India's security or the India's potential, they require special majority. But how much are you allowing to the outside people? Only 74% people, 74%. So they cannot decide anything which is against India, even if they have 74% ownership in the company. But if you allow them 76%, let's say the war is against that country itself, and they can say, hey, you know what? India should not make any arms for the war. Okay? Uh, you can do either direct investing. So let's say if there's a very nice, let's say I want to invest money in Tesla, right? So what do I do? Tesla is listed in New York Stock Exchange. So what I do is, first of all, I try to spend some time reading the legal documents, the restrictions, the requirements, the regulations of a US stock market, get my account opened in the US market, right? That itself is a very big task. And then converting my rupees into dollars, then investing the money there. And when I want to take the money out, understand the tax system in the US, take the money, convert it back into rupees, and get it home. I'm like, dude, I want to invest money in Tesla, but I don't want to invest money in Tesla, right? So in this case, this is what we call as direct investing. But there are lots of other avenues to invest money in the market, and this is what we call as depository receipts. What is depository receipt? Think about, imagine Tesla was listed on Bombay Stock Exchange. You don't have to open any other demat account. You do not have to understand the regulatory requirements of the US. You don't have to convert your INR into USD. You don't have to convert USD into INR back. You're like, what the hell I'm talking about? Or it's not happening with Tesla for the Indian market, but it's happening for lots of Indian stocks in the foreign markets. So ICICI Bank and Infosys, These two stocks are listed on New York Stock Exchange, and they are listed in dollars. So when you buy that particular stock in the US market, technically that means that you bought some shares in the Indian market. So there's some ratio going on. And this is what we call as American depository receipt. So what is an American depository receipt? When any stock outside the US is listed in the US market in the US currency, we call it ADR, American depository receipt. But this is so easy. This is good for the foreign investor, like a US investor who wanted to invest into these companies. They can invest it in their domestic demat account, in the domestic market, in the domestic currency. It is good for the country, it's good for the company itself, which is listed in the India. If ICICI Bank, let's say they had to raise money, initially they could raise money only from Indians. Now they can raise money from Americans as well. And think about the most important part. Let's say there's an MNC company who wants to give a assignment or a project to one of the Indian companies for some of their technology requirement. And they got a choice of Infosys, TCS, Wipro, and all of these. That MNC company will think, Arey yaar, Infosys is a very big company because they are also listed in New York. I know this company. So they will be biased in favor of Infosys. So technically you're doing your marketing in the foreign market where your clients are. So no wonder, right? If you go and attend any particular coaching class, they will give you the बाकी कुछ देंगे या नहीं देंगे बैग पक्का वो दे देंगे तुम्हें any company you work with they'll give you the bag the office bag with the logo of the company because technically you are like a brand ambassador you're going throughout the city in your traffic and doing the marketing for the company hey I work with this company exists right so there could be a GDR global depository receipt means if it's happening outside the US in that local currency we call it GDR. But if it's happening within the US, we call it ADR. This we already discussed about. Cumulative preference shares have less risk than the non-cumulative one. I think that's stating the obvious. We already talked about it. Now there's something called book value, the market value, and the fair value. There are three different things. Book value is the value of the company as per the company's balance sheet. Right? So what is the common shareholders value as per the company's balance sheet is what we call as book value. But the market value can be very different, which is nothing but the share price of the company in the market. So guys, there's a possibility that the company's book value is 1,000 crore rupees, but the market value can be 1,500 crore rupees. What could be the reason? Because first of all, some of the items in the balance sheet may be shown at a historical cost. Remember we discussed about it? Can you show it at the present value like land and goodwill and all of these things? No. But people understand, right? The company has got lots of value. So that's the reason market value can be a lot higher than the book value. So this and there's something called fair value, which can be different from book value, which can be different from the market value. Fair value is what you think is the fair value of the company. Now, if everybody has got the same view, everybody will think that the fair value is worth, let's say, 1,600 crore rupees, and then the market value will also become 1,600 crore rupees. But the point is that different people have a different expectation, different assumptions. So as a result, my fair value of the company could be very different from your fair value of the company. And if the market value today is 1,500 crore rupees, that makes me think that some people think that the fair value of the company is less than 1,500 crore rupees. So they're ready to sell the shares. And some people think that the fair value of the company is more than 1,500 crore rupees. So they're ready to buy the shares. As a result, because there's some number of people who wants to buy, now some number of people who wants to sell, the share prices are being stuck here. If everybody wants to buy, but there's nobody who wants to sell. So think about guys, tug of war. I'm sure you would have played tug of war somewhere, sometime in your life, right? Think about there are 20 people on one side and one person on the other side. What will happen? You just get dragged on one side completely, right? This is exactly what happens in the market. If there are no buyers, there are only sellers, the market would crash. If there are only buyers but no sellers, the markets will just like skyrocket. So because it's 1500, it means that some number of people who thinks it's worth more than 1500 crore rupees, and some people think it's worth less than 1500 crore rupees. So tug of war में क्या होता है? Let's say this is the starting point. It'll go slightly here, slightly there, keeps moving, right? But there's an equal force on both the sides. ROE, return on equity, I think we have done good work. We already talked about it when we discussed financial statement analysis. Anybody who was not there in the FSA class? All of you were there in FSA class? So you know, right, ROE? If ROE is higher, that's generally considered to be good. But we have to break it down ROE into like, the DuPont analysis, 3 stage and 5 stage to understand why ROE is higher. That's very important. Now, guys, there are ratios, price to book ratio and all of it. We'll discuss in the last chapter when we talk about valuation of a equity company. But I told you two things, right? Valuation of a company will be high for two reasons. One is growth, the other one is risk. Higher growth and lower risk is what you want. So any company with growth being higher and risk being lower is what will be worth more compared to another company which has a lower growth and a higher risk. And this point of time, guys, I can do a very interesting analysis for you. I'm not sure whether I've done it with you guys in the past, but it's very interesting. So there's a ratio called price to earnings ratio. What is price to earnings ratio? If I look at a share price of a company, let's say the share price is worth 200. And if I look at the earnings per share, how much money or how much net income the company is making per share, let's say the company is making 10 rupees per share. It means if this is the market price, this is the earnings, the price to earnings ratio is equal to 200 divided by 10, 20 times. What does it mean? That if you buy the share today, you'll have to pay 200 rupees, and on this 200 rupees, you will get 10 rupees ka return. So technically, by investing 200 rupees, you'll get 10 rupees. So to make 1 rupee, you have to pay 20 rupees today. That's one way of looking at it. If you do the inverse of the P ratio, you get your total return. You are getting a 5% return. Because if you put 200 rupees, you are getting 10 rupees, which is equal to 5% return. Or this would also mean that if you want your money back, this will take 20 years to get your money back because you invested 200 rupees, you're getting 10 rupees back every year. So it'll take 20 years to get your money back. But this is considered to be the darling ratio for the financial market. Everybody loves this ratio because this is such an important ratio. This is like the language of the market. People talk about P ratio, right? So think about there's a company, let's call it company ABC, which is available at 20 times the P ratio. This company XYZ, the share price is a lot higher. The share price is worth 5,000 rupees. But this company also gives you an EPS, which is much higher, 250 rupees. Is company XYZ more expensive? No, they're worth the same because though the share price is more, but the EPS of the company is also more. So in whether it's company ABC or company XYZ, in both the cases, I'm paying 20 rupees today to get 1 rupee per share going forward. But think about, guys, there's a company PQR. The price is 2000 and the company gives me an EPS of just 40 rupees. So the P ratio is 50 times. So between XYZ and PQR, You are paying lot more money in case of PQR, but in return, what you're getting is the same 1 rupee of profit. Do you understand? Now, what would you prefer, buying XYZ or PQR? So if you're getting same 1 rupee of profit, you want to pay less today, right? To get that 1 rupee profit. But if that is the case, guys, and if everybody thinks the same, the price of XYZ will start going up because everybody is buying XYZ and nobody is buying PQR. So the price of PQR will start coming down, right? So maybe the price will come to 1500. The price will go further up, and here the price will come further down till the point that, oh, sorry, I put an extra zero, till the point that both of them are giving the same investment for each 1 rupee of return. So generally the P ratio should be same, but let me show you the real life. Things are not that fair and equal in the market. We discussed about it at the start of the today's class. Hindustan Unilever. Look at the P ratio. And guys, I'm not making up anything. This is right there, 61 times. It means if you put 60 rupees today in the company, you'll get 1 rupee ka profit. I don't have a problem, but then look at this company. Oh, you're paying almost half the money and still getting that 1 rupee profit. And maybe, sorry, this is not the bank. This is not the one. Look at the P ratio. Just paying 18 rupees or less than 20 rupees, you're getting the same 1 rupee of profit. What you're getting by investing into Hindustan Unilever as a company and paying 60 rupees. And people are happy with both. People are happy with HDFC. People are happy with HUL. How do you make sense of it? Why would people buy HUL when they to pay 60 rupees to get 1 rupee ka profit? Versus they can get the same 1 rupee profit by investing only 20 rupees, or not even 20 rupees, 18 rupees 87 paisa in case of HDFC. So rather than buying one share of HUL, you can buy 3 shares of HDFC and get 3 rupees profit, right? So guys, the reason people are ready to pay a lot more for HUL is there are two reasons, which I again discussed at the start of today's class. One is risk. What do I mean by that? If you put money in HUL, you'll get 1 rupee profit in the next 3, 4, 5 years. But you know what will be the volatility? If it's a bad year, you'll get 0.9. If it's a good year, you'll get 1.1. And if it's a normal year, you'll get 1. So on an average, you got how much? You got 1 rupee. But in case of HDFC Bank, because cyclical, it's volatile. If it's a bad year, you'll get 0.5. If it's a good year, you'll get 2. And in a normal year, you'll get 1. So here also you're getting 1 rupee. But guys, which 1 rupee is better? HUL ka 1 rupee or HDFC ka 1 rupee? Now, some youngsters, some aggressive people will say, I don't care about it. At the end of 3 years, I'm getting 1 rupee in both the cases, right? But think about it, you're a retired professional, very old person. You're using this money to manage your retirement. In case of HUL, when your portfolio goes down to zero point 0.9, you cut down your expenditures. You do not eat maybe, like at Burger King, maybe you go to McD. Maybe you do not wear CK and Tommy. Maybe you start wearing Allen Solly and some of the basic brands. Maybe you do not go to a five-star hotel, you go to four-star hotel. You kind of manage. But next year you have a gala time, right? You can again start going to five-star hotels. You can make more visits to five-star hotels. You can treat yourself more because you got some extra money. But in case of HDFC, forget about buying things. Maybe you'll have to go and you have to stop going to the hotels now. Forget about five-star becoming four-star. You cannot afford going to hotels. You cannot afford having food, proper food. You should cut down the consumption. Don't eat wheat and rice. Maybe eat some inferior goods because you don't have enough money. Next year, when you got lots of money, you can go for a seven-star hotel. So the volatility. Nobody likes volatility, right? So as a result, both of them are giving you 1 rupee profit, but I'm ready to pay more for this 1 rupee given it's less volatile. So guys, technically, it's nothing but lower risk. That's number one thing. But is that enough? No. The second important thing is HUL is going to grow very fast. Today, both of them are making 1 rupee each. But guys, HDFC Bank will grow. Yes, it'll grow by one. It'll become 1.1. But this 1 rupee, especially in case of India, is expected to become double. So though you are paying more money for HUL compared to HDFC, but if you look 3 years down the line, HUL ka 1 rupee will become 2 rupees. But HDFC ka 1 rupee will only become 1.1. So you're not paying for this 1 rupee, you are paying for this 2 rupees. So you're also ready to pay more on this 1 rupee given higher growth potential. So guys, that's the second thing I talked to you about, higher growth. So HUL is in a very, very sweet spot. They have a lower risk and a significantly higher growth. As a result, the P multiple is 60 times. On the contrary, HDFC Bank, cyclical stock, the risk is higher and they're a very mature company. So the growth is lower. And guys, I can do this exercise for many more companies. Think about Tata Motors. What do you think will be the PE? So the way I'll think about is the risk. Yes, it's very cyclical, but urbanization and everything, the growth is also higher. So they got one good part, which is the growth part, but they also got the risk part, which is much very high. I think that they could be somewhere between HUL and Tata Steel. Uh, I don't know why the P ratio is so bad, guys. Doesn't make sense to me. So don't believe everything, but yeah, this looks very low. I don't know why. But think about some of the other defensive names, like let me try Apollo. Let's try Asian Paints. I would think that again, very non-cyclical. Like you need to paint. You can postpone the consumption of your house, but you cannot postpone paints for a long period of time. And guys, like this is something which is really growing in the country. So the P ratio should be very strong. See, 58 times. Titan, so should be very, very strong. Why am I not getting it for Titan? See, 88 times, right? ITC, by the way, very interesting one. What do you think about ITC? Cyclical, non-cyclical? अरे यार market नीचे चला गया, stop smoking. Doesn't work like that, right? Very defensive. I really believe that ITC should be at a higher P multiple. But the problem here is though the risk is lower, but the problem is growth. यहाँ पे growth नहीं है. So even ITC says, our consumption is falling every year. Number of people who smoke and the number of cigarettes we selling is going to decline every year. उसके बाद भी 30 times का P multiple है. So guys, gone are those days, right? It used to be a status symbol. Oh, by the way, like you are the current generation. Like, is it a status symbol in your like circle if somebody smokes? And be very, very candid about it. Not what you think, but what the group thinks. Is that a cool thing that if somebody is smoking?
No,
Sorry,
no, sir. Not cool.
not anymore. But guys, like, I don't have any shame to say that, when I was in college, it used to be a fashion thing. Oh, wow, you smoke. Cool. So, and you can look for ITC volume outlook, ITC volume outlook. Long term. No, this is just like this here, guys. So don't get carried away by this. Okay, forget about ITC. Cigarette volume outlook, long term. Oh, there's an annual growth, guys. I'm surprised. I thought there's an annual decline. So India is still like, not in that stage where they're seeing a decline, but some of the outside companies, they have started seeing decline. So I think Philip Morris, they have a negative view. पता नहीं दिख नहीं रहा guys, but even if there's a growth, it's a very, very small growth. Despite that, the company is trading at 30 times. Okay? So this explains you that lower risk and higher growth is what all matters to drive a company's valuation higher. Cool. So let's jump to the next topic. And we'll do some questions, guys, when things get a bit more interesting. And this is about analyzing a company. So let me take you back to the table of content so that you have a broader picture in mind. So what we are going to do is if you want to understand and if you want to analyze a company, you first of all want to understand the company, just not only the present, but also the past. Just understanding company is not enough. You have to also understand the industry. Once you know about the company, once you know about the industry, you can do the forecasting of the company. And only once you can do the forecasting, only then you can do the valuation of the company. Okay? So we are starting with company analysis, past and present. Company research report. Maybe I'll see like if I can find some of the research report for any company, for any bank. So, that will be a very practical explanation of everything we're going to discuss here. So um, think about Reliance Industries. By recommendation, hsbc.pdf. So this is like a typical equity research report, right? You all know the name Motilal Oswal, and they have written a research report on Reliance Industries. So how does it work? Motilal Oswal would have done lots of deep dive research on the company, and based on their research on the company, they came out with this view on the company. What is their view on the company? It's very evident that they think that okay, the current market price is 2,472 rupees. The target price or the fair value of the company, according to Motilal Oswal, is 2,855 rupees. As a result, they see an increase of 15% increase in the share prices. As a result, they have a buy recommendation on the company. But guys, though this report is 36 pager, but the way this report is structured is very, very important. First of all, if I have to guesstimate that if somebody has started doing the research on Reliance Industries for the first time and to come out with a 36 pager report, they would have read about the company, they've read about the industry, they've read through the company's annual report, they have gone through the company's transcripts, the earnings call, the company's financials, putting all of them in an Excel sheet, making some nice summary sheets, nice charts, which you can read through, which you can see through the report. See these charts and tables and everything. There's lots of data behind it, right? So in this case, that person would have taken a couple of months. But if I am the reader of the report, the first page of the report is very, very crucial. So I don't know whether it's in public domain or not, but I've also written some of the reports like these, with my private banks. And when you write these reports, we are told that, like, one of the reports I remember, I wrote on nickel as a commodity, like what's its outlook with electric vehicles and with so electrification and everything. It was a 50 page report. And I was told that if you're lucky, and the kind of work I did, I had data about each and every nickel mine. I had data about how people are consuming nickel. And we paid like, few $1,000s to get some of the data to just write that report. And we were told that, and we spent like a couple of months on it, like late night, midnight oil. And out of this 50 page report, we were told that you to summarize that entire 3 months of work in a 50 page report, which itself was a big task. Then we were told that, oh, somebody may not read 50 pages. So can you summarize the entire 50 pages in 2 pages, which will be the executive summary, page 2 and page 3 of the report. Those 2 pages has to be summarized in the first page in 2 or 3 paragraphs. And those 3 paragraphs have to be summarized in 3 bullet points at the top of the report. And that has to be summarized in the company's title, the report title. So if somebody likes the report title, they'll read the 3 headlines. If they like the 3 headlines, they'll read the 3 paragraphs. If they like the 3 paragraphs, they'll read the next 2 or 3 pages. And they really like the 2 or 3 pages, they'll go and read your report. So guys, if somebody comes asking you a question from page number 29 of your report, you are a star analyst. Okay? So this is being covered. So a company research report includes an analyst valuation and investment recommendation. What is the analyst valuation? In this case, Motilal Oswal's recommendation is a buy. And what is the company's valuation according to Motilal Oswal? That there's a 15% increase in the share price, which is possible. See, front matters. Example, issuer name, like what's the company's name, whether it's a buy, hold, or a sell recommendation, target price, and the legal disclosure. Do they have a legal disclosure here? They'll have lots of legal disclosure, by the way, if you go to the end of the report. See, when you have time, just read through it, disclosures. But they're just like terms and conditions of an insurance company. Nobody reads it. So generally we'll say, the report ends on page number 34. Rationale for recommendation. Now nobody gives a damn about what Motilal Oswal thinks. If Motilal Oswal says, like, I think Reliance Industries is a good company to buy. I said, dude, I don't care what you think. Tell me, why do you think so? Right? So, rational. Why do you think it's a buy recommendation? So, I think if you look at the front page, that's being covered. Why they think it's a good company. Now, guys, this is not like a typical report, by the way, because this is the just like a reaction to how the company reported the 2Q results. So maybe let me open another report. Reliance Industries initiation target price. Hmm, this one. Maybe ICICI as a research house, they have come out with this report. Different research house, but guys, something similar, right? Who is the issuer? What is the current stock price? What is the target price? What is the upside? Everything is similar. But see, why do they have a buy recommendation? What should investor do? They should buy. But why? What are the key triggers? Maybe a value accretion, FCF generation, healthy cash flow. So they always say like those three bullet points why the company, why people should be buying it. And it's just like not one page of report. There's more detail when you go further down. So the front page is very important. And like you'll get lots of details about the company's financials, companies, like the ratios and all the basic information. So like see, I cannot believe P ratio is not part of the front page. It has to be a part of front page. Not just for ICICI Bank. Was it part of the Motilal Oswal report as well? I think it was, right? I'll be really surprised if it's not. See, PE multiple. So rationale for recommendation. The report should include company description. So many times, there could be people who do not have enough background on the company and they are new to the company. They want to invest. So there should be an enough description on the company as well. Luckily, in this one, we are seeing the ICICI Bank call example. Where did it go? Sorry. Where is ICICI go? Oh, see, the first thing you see about the stock is nothing but about the description. So many times, let's say if I start telling you about a company and you're like, wait a minute, dude, I don't even know about the company. You're telling me how the company's growth can accelerate, but tell me at least what the company is, right? कई बार होता है, right? Like I went for a meeting and the person starts telling me that, this is how this particular thing works. Oh, sorry, this is what the share price of this company is going to do. I said, before you start doing it, tell me what the company is you're talking about, right? So about the stock, what the Reliance Industries does, how they make profit, how big the company is. Some people don't put it on the front page. They put it sometime at the back of it. So maybe Motilal Oswal is not doing it here. They would have done it somewhere in the back of the report. So it's very important that you highlight the description. You give the industry overview. So if you talk about Reliance Industries, but you don't talk about the industry overall, even if the company is doing good, but which company can do good when the markets are bad, right? So that's the reason there's a whole topic we are going to cover, which is about industry analysis, financial analysis and model. You try to see, like what the company's performance has been, how the company is going to do in terms of various financials. So if I look at these reports, both the reports have financials, right? This is what the company did in 2022, and this is what the company is going to do in 2023 and 24. Sorry guys, the report is dated 2022 का report है. So in 2022, obviously 2023 and 24 were more of an estimate. Valuation. What is the value of a company? The target price. This is very important. Everybody's talking about it. Environmental, social, and governance. 20 years back, nobody cared about it, but now this thing is really becoming important because if you do not follow ESG, environmental, social, and governance, people penalize you. the regulators penalize you. There could be lots of penalty, so the valuation can go down. So the first thing, guys, whenever you look at a company is you have to understand how the company makes money. What's the company's business model is. So I keep asking question, what's the business model of CRED? Have we discussed about CRED before in this class? CRED, CRED, CRED is an app.
No, sir.
Yeah. Have you used this app before?
Heard of it, never used it.
Any idea? Anybody who's the user of CRED as an application?
Yes, I have used.
How does it work? But so we have discussed about this CRED example before, right? In one of the
Yes, sir,
previous.
yes, we have.
Yeah, but I think that was like a prior batch because I remember discussing it.
Yeah, prior batch maybe.
So the question here, guys, and sorry for repetition if it's a repeat of the example, but it's important that we discuss it. I see some new people in the class, Neha Patel and Chaitanya. Is this your first session in this group
Yes, sir. This is my demo class.
or demo class? Okay, okay. I'll just request you to keep your video on. And not only for Sneha, that's applicable for everyone, guys, please. So in this case, what is the business model for CRED? Anybody who's using CRED and if they can give some insights like what the application does, how does it work, that'll be great.
Now, I guess like what I understand, like they kind of help us manage the credit card payments. They charge a commission on the credit card payment. Plus, I
No,
think
no, 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 no. They don't charge a commission. They give you cash back.
they are like they give a 2 rupees or 1 rupees cashback.
Now it's like everybody started using it, but there were good
Um,
times. I used to get like
um,
30 rupees, 40 rupees as a commission.
Plus, like they kind of provide lending services also, like cash. Like they have cash and other things on which they charge interest also.
But that's new, right? But the core
Uh,
business, if you ask, they simply provide a platform where you can
mhm.
see all your credit card bills, right? And you can make the payment. Like it's much faster than making the payment to to the bank's website. So guys, let's say I've got like credit card from HDFC, I've got credit card from ICICI Bank, I've got credit card from Bank of Baroda. Or don't judge me that I have a card from Bank of Baroda. I have to take it because of some issues. So now in this case, all the three cards I can see at one place. And let's say if I want to make a payment, I don't have to go to three different websites to make the payment. And when I make the payment, it does not take like 2 or 3 days. It's an immediate payment to the bank. I love it. And on top of that, you're getting some money back. It's even better, right? And by the way, guys, I don't know how they do it. Initially, any of you using Cred, by the way? Any of you?
I have.
You have, okay. So they have come out with a new function in the app, like your vehicles.
Yes.
Trust me, guys, I did not put the details of my car. I did not put the details of my bike. They simply asked me a permission that, do you want to activate your vehicle wala part here? And I just said yes. From somewhere in the system, they could figure it out. What's my car number? What's my vehicle? What's my Activa number? When the insurance is due, what all challans I have got? What's the uh, Fastech balance? Everything is at one place. I love it, but I'm concerned. Where did they get all this information from?
They get the similar information on loans, electricity payment, and everything.
Yeah. So you just allow them. So it's very scary, guys. Like as they say, right? Though we are talking in this room, but the entire world is hearing us currently, right? So it's very, very important that you mind your language and you mind your words. right? Not in terms of slangs, but what you like, don't share confidential information anywhere. So cred is very powerful, but guys, how do they make money? The money, they do not make money by providing you a platform, by allowing you to make the credit card payments. What's the core business of cred? How can they make money by giving you the rewards and cashbacks? They don't get any
D-
kickback from the credit card companies.
I guess data shit data.
Yes. So the company founder itself says that we are in the business of data. So technically, though you get 2 rupees reward, but technically you are selling your credit card bill to them. You're allowing them that your credit card bill can be shared with others. But they won't share your name and the mobile number and your contact information, but they'll just share, like, the lower half of your credit card bill, that X person from Y city from Z address has done these transactions. And if some buyer will come, will buy all the credit card bills of, let's say, 10 crore people from cred, and if they can use some tool to summarize these credit card bills in a one nice simple analysis, saying that, oh, there are more and more people spending more and more money on credit card bills in the recent months, means India economy is improving. People are spending more money on hotels and luxuries. Oh wow, these sectors are going to do better. Within hotels, people are moving more of Taj hotels rather than ITC hotels. Or Taj is going to do better than ITC. You can take a call on the companies. So see, the focus is that you have to understand how the company makes money, what the company's business model is. Sometimes the business model is not what you think the business model is, right? Like I went for like one of these sessions, in a school, actually, very young people. And there was just some session, and I asked people, okay, like, do you use YouTube? All of them said yes. I asked them, like, how do YouTube makes money? They were like very nice, small, innocent people, like, in the age group of like in teenage. And all of them told me that, like, you can make videos and upload that on YouTube. And this is how YouTube makes money. My question to them was like, do you pay money to upload a video? All of them knew that you don't have to pay money. And by the way, guys, out of like these 70 odd people, there are 15 people who had a YouTube account where they have uploaded a video, not just watching a video. They have contributed. So they didn't know, but I'm sure that you know, right? What's YouTube's business model? Is it like videos being uploaded and
Thanks.
advertisement, right? So it's important that you understand the company's business model. Sometimes it's not very obvious. So what describes the company's business model? Like the products and services they're offering, who the customers are, what's the sales channel, pricing and payment terms, and everything. So there are many FMCG products, right? Who are like, B2B, like I would say HUL. Have you ever bought like a HUL product directly from the company ka factory? No. The factory will give it to the distributor will give it to the wholesaler to the retailer will give it to you. But there was a thing like Ole or something, I forgot the product name, Oriflame karke. There are lots of brands which are B2C. You will get it from the company's factory and you give it directly to a consumer. Same business, everything being same, but the sales channel is very, very different. You don't sell it through the traditional way of wholesalers and retailers and everything. You sell it directly to the consumer. So guys, it's important that you understand, like, let's say the customer of a Maruti versus a customer of Ferrari. Both of them are buying a car, but are they the same customer set? No, different people altogether, right? People who are buying a purse from Louis Vuitton versus a person who is buying a purse on the roadside. Both of them are buying the same product, but is the demography same? No. So you have to understand a lot about the company, but to understand the company, where will you get the information from? Now, obviously, you can get information from the companies provided data like the company's financial statement, like the company's balance sheet and the financial income statement and the annual report. But you can also get information from directly from the company itself. Sorry, you can get the information from the company annual reports and the quarterly reports, but you can also get information from third party. What is third party? Social media. Trust me, guys, social media was not the source of information a few years back. It was just like a time pass thing. I don't even know if any of you know about Orkut. Do you know Orkut?
Yes, Ansh.
Even if you know Orkut, never agree that you know Orkut, because that tells me that you are 30 plus. Okay? So when it was Orkut, like people thought like Orkut is just, like our Facebook. It was Facebook equivalent, right? But now people are using social media to understand how the company is doing. Like number of people who are putting a post about that product, putting a review about that product, putting a discussion or a chat or a review about the product. These are very important things, guys. So not only people who are into social media are on social media, but even the research analysts are on social media to understand how what other people are doing. So if I want to understand what the Gen Z is doing, the best way is track them on social media, track them on Instagram, track them on Snapchat, track them on Facebook. You can get lots of information from third party like Bloomberg, but you have to pay them lots of money. And you can do your own research, like your own primary research. But guys, you have to be creative. How do you collect information? The first information, which is directly from the company, it's very easy to get. But the thing is, everybody will have it. Social media wala, you have to be a bit creative. That how do you summarize and how do you condense that information? Let's say you go through 10,000 different Instagram accounts. These different people are saying different things. How do you condense it? How do you summarize it? And can you read each and every post from each and every person? No. You need some tool, you need some data uh, processing tool, Python, BI, I don't even know what are these tools to process the data. Okay? So we'll try to see like, how do you forecast what and guys, I'm not getting into the forecasting. I'm still like in the past and the present. I'm not even into forecasting yet. So I'm trying to understand what has happened and what is happening. What can happen is a different topic altogether. Okay? So we'll try to understand about the company from the revenue drivers. What is driving the company's revenue? That obviously revenue is based on price and volumes. So what is driving the company's price? What's driving the company's volume? And these are the things I'm going to discuss next. So let's take a break. It's a long session we had. So it's 12:05. We'll be back at 12:25. We'll go on for another hour, 15 minutes and close it then. Cool. Thank you guys. See you in 20. Okay, guys, let's continue. Let me know once you're back. Okay, so in terms of revenue drivers, like we should know how the company is getting its revenues. Now, in this case, we should do both the top-down and bottom-up approach. Bottom-up approach, like, is just trying to understand how the customers are buying things. I'm looking at each and every customer and totaling it up. It's called bottom-up. Or I look at how the broader economy is doing and trying to understand how the company is doing. This is called top-down. टॉप डाउन मतलब ऊपर से नीचे आना मतलब ब्रॉडर से नीचे आना like this is how the funnel would be, and bottom up like you're looking at like small parts and trying to build up and total it up is what we call as bottom up analysis. Now when you look at the company's revenue driver, obviously pricing power is one of the important things, and in this case not all the companies have a similar pricing power, right? Take an example of we had Tata Nano, right? The whole selling point for the car was that it's the lowest price car, and let's say they were launching it at 1 lakh rupees, and they say we are increasing the price by 10%. What do you think will happen? Are there still same number of people going to buy the car? No. The reason people are buying car is cheap, and when you make it expensive, lots of people will back out. But think about Ferrari. If you increase the price of Ferrari by 10%, will people drop the decision of not buying the car, of buying the car? No. So as a result, maybe Ferrari has a lot more pricing power than what Tata Nano has. So this is important for you to understand, because if you have a pricing power and if you increase the prices by let's say 10%, your volumes will fall, but the volumes will not fall by 10%. As a result, your revenues will increase. And guys, when your revenue increase because of pricing, the beauty of that is there's no incremental cost of it. When your revenue increase because of volumes, there's a cost to make those volumes. But if your revenues increase because of price, there's no incremental cost attached to it. Now, there are many people like who can produce that particular thing at the lowest cost possible. So think about, let's say, gold, right? You must be hearing a lot about gold prices these days. The custom duty changed during budget. As a result, there has been lots of volatility in gold prices. Now, in this case, let's say today, if I tell you that a 22 karat gold is available for 70,000 rupees per 10 grams. Now, do you care about what's my cost of making the gold from my mine? Let's say my cost is 30,000 rupees, and let's say Nandini's cost is 40,000 rupees, and let's say Ansh ka cost is 60,000 rupees, right? Now, though my cost is 30,000, am I going to sell it at lower price? No, I'm going to sell it for 70,000 rupees and I'm going to make a huge profit. Ansh ka cost being 60, he's still going to sell it for 70. He cannot go into the market and say, you know what, uh, because other people are making 2x, I also want to make 2x. And as a result, I want to sell it for 1,20,000 because my cost is 60,000. No, nobody will buy it, right? But the product is standardized. So in this case, the person who has the lower cost will always benefit, because Ansh Gupta will never sell it for less than 60,000 rupees because he won't be able to meet his cost. But can I sell it for less than 60,000 rupees? Yes, I can. But I won't. Why do I want to reduce the price and hurt my own profit? But technically, guys, I have more pricing power than anybody else because I'm the lowest cost producer in the industry. So a company that has significantly lower cost than its competitors may earn returns exceeding the cost of capital. So when Ansh is making only 10,000 rupees, I am making 40,000 rupees by selling each unit of gold. Now, there's something called commoditization. What is commoditization? It's technically an industry where there are so many participants in the industry, and it's so easy for the customer to switch around. Like I would say, the commoditization is in the sense of number of brands which are offering you hair oil. एक जमाना था, right? Like they're just like almond oils, parachute oil, and maybe another one or two. That's it. But now within almond, they're like Bajaj almond, this almond, that almond. Within coconut, there's parachute, this and that. So guys, it's like a very, very confusing choice if you go and buy a hair oil for you, right? Shampoo, potato chips, cold drinks. Cold drinks, I'll still say is not that commoditized. But when there's too many players in the market, and see, when things get commoditized, it's bad for the supplier, but it's very good for the consumer. So think about, let's say, if you want to launch your own shampoo, if you want to launch your own soap, you have to go through so much competition, guys. So in a shelf, along with other 30 soaps, your soap will be kept. What are the chances I'll buy your soap, right? But as a consumer, like, okay, I'm getting confused, but I'm getting more choices. And because you are competing among yourself to sell your soap to me, you'll keep reducing the prices, you'll keep making your product better, and you keep doing something so that I buy your product compared to the other 30 products available in the market. So these kind of industries is what we call as commoditization. It's really bad for the supplier because the competition is so much that they can never make a super normal profit. And in these industries, they say there's a graveyard of the companies which could not survive. And this graveyard has so many companies that the graveyard is overcrowded. Okay. Now, there's a lots of discussion around switching cost, like how easy it is to switch from one product to another. So let's say if I want to change my shampoo. Last time around, I bought, let's say, L'Oreal, but this time around, I want to buy, let's say, Head and Shoulder. What's my switching cost? हाँ, switching cost ये है कि जो मैंने खरीदा उसको पहले खत्म कर लो before I buy the next one. That's it, right? उसके अलावा there's no incremental switching cost. But think about if I want to change my internet connection from Airtel, if I want to go to Jio. राउटर है वो बोलेंगे काम नहीं आएगा दूसरा राउटर लेके आओ राइट 1,500 रुपीज दूसरा लाइन लेके आओ ऊपर पूरा लाइक इट्स लाइक यू टू ब्रिंग अ वायर डाउन 10 floor down which like almost like 30-meter wire and which is like almost equal to 1,000 rupees again installation cost this cost that cost उन्होंने यार ठीक है ना let it be एयरटेल इतना बुरा भी नहीं है यूज कर लो right now the Reliance you understands that though I want to go to them but I'm not able to get to them because of the switching cost. What they will say is they're smart. They'll say, Acha, if anybody wants to switch, you are most welcome. We'll give you a free router. We'll give you like free wire up to 50 meters and we'll give you a free installation. So guys, we'll talk more about it in economics if you're not covered it already with your batch, like monopoly, oligopoly, monopolistic competition and all of it. Like this will tell you that, how much loyal the customers are and what is the switching cost. So if people are very, very loyal and the switching cost is very, very high, in that case, this companies or this industry can charge very, very high price because people can't shift. People cannot change to something else. There's a concept called price discrimination. What is price discrimination? As a supplier, I'm charging different price to different customer for the same product. Like that happens a lot when you go for flight tickets, right? On the same route, for the same distance, for the same type of seat, because you booked 3 months in advance, you're paying 5,000 rupees, but somebody else who just booked like just in time is paying double the cost, let's say 10,000 rupees. That happens quite a lot, right? So this is what we call as price discrimination, that you charge different price to different customers for the same product. Now, one important thing, guys, is the profit margin. How much profit margin the company is making. So let's say there's a company which is making a 20% margin and another company which is making a 50% margin. See, 20% margin to har koi bana leta, right? So let's say you purchase it, you sell it for 100 rupees when your cost is 80 rupees. So let's say if I've made something, right? Let's say if I just done a packing, like, okay, let's say I've created something from cardboard or I've just created something from paper. And you can see, yaar, हाँ, हाँ, इसको बनाने में 80 रुपया cost गया होगा, right? You'll be like, हाँ, like 100 rupees is worth it. Let's say, for example, whenever I go to buy a book, right? This is how I do. अच्छा 300 पेज है, राइट? आज के दिन 300 पेज का प्रिंट आउट लेने में 500-600 रुपए लग जाते हैं, राइट? तो paying 400-500 rupees is not a bad idea for this book. If I go and buy some furniture, I'll say, acha, this much of wood have gone into this furniture. So paying this much money is not a bad idea. So when you know that your cost is 80, you can easily charge 100 rupees from the customers, right? As a result, your commission will be equal to 20%. But if your cost is 30 and still you can charge 100 rupees from your customer, that tells a lot that you have got some purchasing power because you're able to generate a profit of 70%. It means there's something in your product which others are not able to compete with. There's something in your product which is very, very unique. There's something in your product which others are not able to copy. Because otherwise, there's no reason that how you can sell something worth 30 rupees for 100 rupees. So that's one important thing, that how much is your operating profit margin. If your profit margin is more, it tells you that the product is very, very strong. People are very, very loyal, or something you have done with the product and the service that people cannot move to something else. And the second important part is, let's say this company has a 70% profit, but sometimes it goes to 45%, sometimes it goes to 75%, sometimes it goes to even 90%. But on an average, it remains around 70%. But another company, it's 70%, sometimes it becomes 69%, sometimes it becomes 71%, sometimes it even goes to 72%. Both of them have an average of 70. But guys, this 70 is so much better. Not because of volatility is less, but this tells you that whether the market is good or bad, this company can have a consistent 70% profit. It means their profits do not get impacted by the market conditions. And that's like a very, very strong proposition that, wow, even when the market conditions are bad, the company's profitability do not get impacted. So if there's a deep recession in the economy, maybe this 45% might go to 0%, but this 69 will become only 65%. So profit margins can be an indicator of a pricing power or how good and how strong the company is. You look at macro factors, how the market size is growing. So let's say you are, did I tell you this thing? Like one of my friends asked me like, some money and he wanted to open a mobile store in Bangalore. Did I tell you about this? Did I mention it? He's a very good friend
No.
of mine. I really wanted to help. But when he mentioned that he wants to open a mobile store in Bangalore, I got like switched off. Because in case of Bangalore, like I would say like 95% of the mobiles are not being bought on the store. They are being bought online, right? And even if people go to the store, they do not go to like the standalone stores. They go to maybe Reliance Digital, Chroma, and those kind of things. So I asked him, okay, are you going to sell like, those small budget mobile phones? No, he was like, no, I'm going to sell iPhones and Samsung car, like those uh, proper high range phones. I said like, dude, how can you compete? How will you compete, right? So in this case, if the market size of a physical mobile stores is reducing, even if his own venture does really good, it's very difficult. So think about the market is going to become half. Even if his market share increases, his total sales will still come down, right? So it's very important how the market size is increasing. And here the market size, I'm not taking the total sale of smartphones. I'm taking the sale of smartphones at the physical retail counters. So that's very important how the market size is improving. There's another thing like, right next to my house, there's a college and there's a maid, like a house help. And her son was planning to open a small Xerox shop next to the college. And like it was a good investment, like you have to take a shop, 20,000 rupees rent, buy a Xerox machine and those kind of things. I said don't do that. So they're just seen in the old times, right, how a Xerox shop will make lots of money sitting right next to the college. And guys, I know that you have to be friends with the Xerox guy so that he can give you the Xerox first when there's a line of people there, right? And some decent part of the pocket money used to get used to go in getting the printouts. But gone are those days. अभी कौन लेता printout? Trust me, guys. I've got a printer sitting right next here, and I got like a 200 page ka bundle like 7 months back. अभी तक 200 पेज खत्म नहीं हुए उसके. You scan it, you mail it, you send the photo. When do you take the printouts? Oh, I take the printouts for my kids. That's the only time I need the printouts. I took a home loan. I did not have to take a single printout. I had to buy a house. I did not have to take a single printout. Nothing. So market size is very important. And this is what we'll cover when we get into the industry analysis part, that how do you analyze an industry and the market share, like how you are growing within the industry. So one thing is industries should be growing. And then the second thing is you should be growing in the industry. If both these things are happening, you are in a right spot. But if you're a part of a dying industry, and even if your share is growing in the industry, but because the industry is dying, you are not a great company. So that was about revenues. When you go to cost, you have to understand that there could be a fixed cost or a variable cost. Variable cost will increase if you make more volumes, but the fixed cost doesn't increase even if you make more and more volumes. We have discussed about it when we did financial statement analysis. Now, did we talk about operating leverage and financial leverage before? I think we did, right? Operating leverage, financial leverage, and the combined leverage because of the fixed cost component.
Yes, Ansh.
Savik, like I think you were in the other batch, but even people in the new batch who was joined recently, do you remember we did it? Operating leverage, financial leverage, combined leverage. And Savik, we did it as a part of which topic, by the way, if you recall?
Um, I I can't remember properly, but I think we did sometime in the corporate issue or when we were discussing the working capital part.
Corporate issuers, right, right.
Um,
So
I
guys,
think
if
we discussed it.
we discussed it, right?
I guess we discussed it.
Cool. So guys, if you're not done corporate issuers and if you didn't remember not doing it, don't worry, it will do it as a part of corporate issuers. But this is like here they just mention it like in very short, but we did a very detailed example and formulas, you know, when we did it properly. Yeah. Now there's something called economies of scale and economies of scope. What is economies of scale? That if you're making 100 units versus you make 200 units, if you make 200 units, your cost doesn't double because some of the costs are fixed, right? So you get lots of benefit because you are a larger volume producer. So think about if you have to make 100 cars versus Tata Motors is making thousands of cars. You still need a factory line. You still need like all the equipments. Still you need like all the expertise. But Tata Motors, because they're using the same set of assets, the same equipment for 1,000 cars, the cost per car will be much lower. This is what we call as economies of scale. What is economies of scope? It's not about making more volumes, but making more products which are in the similar business. So let's say if you are selling copper, why don't you sell aluminum as well? Because Just like copper, aluminum will also be sold to the manufacturers. That will also be taken out from the ground. That will also require labor. That will also require government permission, right? Let's say if you're taking classes for CFA, why don't you take classes for FRM as well, right? If you have an MBA course, why don't you have an MCOM course as well? If you're making laptops, why don't you make mobile phones as well? There will be lots of overlap, right? The customer base is similar, the supply chain is similar, the technology could be a lot of similar. So this is what we call as economies of scope. Now guys, economies of scale sounds good, economies of scope sounds good, but just like there's economies of scale, there's diseconomies of scale as well. What is diseconomies of scale? The problem of being too big. So you should be big enough so that your cost is small. But if you become too big, it backfires. Can you tell me, economies of scale makes sense, right? It's very intuitive that if you make more units, you can be more efficient. But what could be the reason for diseconomies of scale? What can go wrong if a company becomes too big?
Maybe unutilized workforce that may.
Yeah, unutilized workforce, right? So let's say I'm the only person and I'm making, like, let's say I'm doing all the parts like cutting wood, joining it, putting a veneer around it, painting it, and everything. And because I have to change, from one work to another work, I'm able to complete just like 10 pieces in a year. But let's say if there are 5 people, one is just doing painting, one is just cutting, one is just like putting a veneer and all. Obviously, the efficiency will improve. But if you have too many people, it's very difficult to track like who is doing what. Then you need to have a manager. If there are too many managers, you need a senior manager. If there are too many senior managers, you need a director. So this kind of hierarchy develops. And still, guys, the organization will be so big that it'll be very difficult to keep track of efficiency at each and every level. People won't have that much motivation, and there will be lots of underutilization of resources. So the best example I give is that, in this case is, let's say when you study, if you study alone, how it can get boring. Maybe you're not good at something and you need somebody else's help. So you do a joint study, right? So maybe you generally make a group with another friend of yours who is not as good as you in a particular topic, but better than you in the other topic. So you can help the friend in one topic and the friend can help you in the other topic. And this works very well for me. Like, this is how I studied in my college and my MBA. But the problem is that if this group gets a bit bigger, if there are 3 or 4 people in the group, this is when it, like, the entire thing just dies down. Then you don't study, right? We call it group study. The group study itself is a grammatical mistake. You cannot study in a group, right? So this is exactly like, if it's 1 becoming 2 is good, but 2 becoming 5 is not that good. Cool. Your degree of financial leverage and degree of operating leverage, guys, will do it as a part of corporate finance in a full detail with lots of formulas around it. Okay, now from here, we are getting into the industry analysis. So we have discussed about company, now we are discussing industry. Again, are we into forecasting part yet? No, we are just trying to understand and develop our knowledge, what the company has done in the past, what the company is doing currently, and how the industry is structured. Now, guys, different industries have different long run levels of profitability. Some industries generally make more profit, right? And there are some industries which are bound to make very low profit. Why? So generally the industries which requires very low investment, they'll have lots of players in the market. And because there are lots of players in the market, these industries can never make a super normal profit. But guys, maybe like some companies, some industries like automobile industry, how many players are there in automobile? Are there like 100 different players in the market? No. To have an automobile company, guys, you need like a few thousand crore rupees ka investment. right? So as a result, the competition will be less, and maybe these companies can make a supernormal profit in the long run. But I cannot imagine a company which is, or a farmer who is selling potatoes and onions can make a supernormal profit, because there's so many people who are selling the exact same product. So how can you make a extra profit in that industry? So unless you differentiate your product, unless you kill your competition, you cannot make supernormal profit in the long term. There could be a difference in business model, company size, competitive strategy. Each industry is different from the other industry. Now, guys, many times what we think is that, Acha, as a company, I'm doing good. How do I care about how the industry is doing? So never ever underestimate the impact of the macroeconomics and the impact of the industry, which it can have on the company. So Tata Motors can never do a good business if the automobile industry is not doing good and if the economic conditions is not good. सोचो इकोनॉमिक रिसेशन में, राइट, कौन खरीदेगा ऑटोमोबाइल? अब टाटा मोटर्स कितना भी अच्छा कार बना रहा हो, कितने भी कम प्राइस में बेच रहा हो, कौन खरीदेगा उसको? एंड वही अगर इकोनॉमिक कंडीशन अच्छा है, even if the car is like bullshit, even if they're charging very high price, given there's such a huge waiting for people to get a car, they'll buy anything and everything. बीच में ऐसा हुआ था शायद, लाइक क्रेटा में हुआ था, या many cars you to wait for 8 months to get a car. So there's lots of black में हो रहा था, मतलब you pay the price, what is the on the road price without any discount. So if you ask for a discount, मतलब they'll throw you out. How could you even ask for a discount? And on top of that, if you need an early delivery and if you've got some jack, you pay like 2 lakh rupees extra to get the car delivered within 1 month. Why? Economy is good, industry is good, company will automatically do good. So if you ask me, like, what is more important, industry being good or the company being good? Industry being good is more important. So if the industry is good, even a bad company can do a very good business. But if the industry is bad, even a good company may not survive. So guys, first of all, define the industry. Now, how you define the industry is very, very subjective. So let's say if you want to talk about the t-shirt I'm wearing, right? How do you define this industry? Is it like only the men's t-shirt is your industry? Or are you talking about the ready-made garments for male as an industry? You're talking about the ready-made garments, whether it's male or female or kids or old. Is that the industry? Or is it about like anything and everything to do with your wardrobe? Like it includes belt, purse, perfumes, everything is part of the industry, right? At what level you define the industry is very, very important. Okay, so you can take a very, very narrow definition or you can take a very, very wide definition. Am I talking about only Bangalore market? Am I talking about India market, or am I talking about the global market? Mobile phones के अंदर, am I talking about like let's say if I have got iPhone 15, I don't have an iPhone 15, I could never afford it. But let's say if I've got iPhone 15, and then I'm saying that the what is the industry for iPhone 15? Is it only this like the premium phones from Apple versus premium phone from Samsung? Is that the market I'm talking about? Am I talking about the entire smartphone market? Or am I talking about the all the mobile phone market, whether it's a smartphone or not those smartphones, like those basic phones? Or am I talking about the entire, like these hardware market, which includes even laptops and the iPads and the Samsung pads? Or does it also includes watch and other accessories, right? So guys, it can be very, very subjective how you define an industry. Survey the industry, like how the industry is doing, what is the current size of the industry, how the industry is growing. Analyze the industry structure, Porter's 5 forces. Remember we discussed in the previous class. So it's very important to do, like whether all the 5 forces are weak or not. Analyze what are the external influences on the industry. So guys, just like there's a Porter's 5 forces, there's an analysis called PESTEL. P say political, economical, social, technological, legal, and environmental. So look at an industry. Let's say if it's a cigarette industry, I'll be really concerned from the political point of view. इस बजट के अंदर पता आईटीसी ऊपर चला गया था शेयर प्राइस. Any idea why did it go up?
No increase in tax.
समझ रहे हो मतलब no bad news is a good news because government is going to look like all the political parties are going to look at ITC as a cash cow. As a result, it's a very bad company technically, right? Because though it's addictive, but still, and the PEEP for a ITC company guys should be at 100 plus times, right? But the problem here is political risk. Economic, some industries are more impacted by economy, like cyclical versus non-cyclical wala debate. Social, ITC, not the only the problem is political, but also the social. It's not considered to be a good thing, right? And there's lots of discouragement year after year after year, right? Like you cannot smoke in public, you cannot have a cigarette shop within the vicinity of the college campus. So those kind of things, like it's a taboo technically, right? Technological, I give an example of a Xerox shop. Everything is good about this shop, but the problem is that it's completely not advisable given that technology is going completely on the other side. You don't need a Xerox machine these days, right? Legal, it's like in some cases, like let's say in property and all, legal overhang could be quite a lot. And environmental, let's say if you want to start your own um, uh, manufacturing unit, आजकल just getting this permission to get this manufacturing unit getting started is pretty difficult. So let's look at, like just like we did Potter's 5 forces, try to look at the pestle as well. This will cover the entire thing. Look at the company's competitive strategy, like how the industry is competing compared to the other industries. Now, when you talk about classifying the industry, the first part, define the industry. So generally people follow the definition of the industry as per Global Industry Classification Standard. It's called GICS. In short, people call it GICS. GICS matlab, they have a particular way to define an industry. I told you, right? Let's say GICS kya bolega ki natural resources is one of the industries, and within natural resources, metals and mining is part of it. Oil and gas is a part of it. Chemicals is a part of it. But somebody else will say, no, the industry has 15 different industries. One of them is oil and gas and metals and mining. Chemicals. So rather than having a group and a subgroup, they can just have it as a part of the main category, right? So guys, all I'm trying to say is that, there's a very subjective way that how you put all the industries together. So the industry standard is they follow the classification and the segmentation as given by this particular institute called Global Industry Classification Standard. There are others as well like ICB and TRBC, but everybody follows GICS. So GICS says that energy is one of the industry, which will include the oil and gas, solar energy, renewable energy, and all of it. Financials, which will include banks, insurance companies. Basic materials, which include all the metals and mining companies. IT, which will include hardware, software. Industries, which will include manufacturing. Telecom, which will include, like not only the social media, but also your uh, hardwares and the telecom providers. So this is how they classify it. And if I want you, if I give you the task to classify it, maybe you don't call it energy. Maybe you'll club energy and the basic materials into a single, what we call as natural resources. Maybe you'll club the IT and telecom into one and call it TMT, right? So there are many ways of classifying it, guys. Now, one company can be into multiple businesses, right? So which part of the industry it will be? Like ITC, right? Or let's take an example. Yeah, ITC is into real estate. Yes, they are into hotels. They're into consumer staples as well. They make these ITC products like consumer goods, and they are also into consumer discretionary, like the cigarette part of it, the cyclical part of it. Sorry, that's also non-cyclical, but they are also into uh, chemicals, which is part of basic materials. They give lots of chemicals to farmers for agricultural products. Now, whether they are part of basic materials, they're part of consumer staples, or they're part of real estate. Obviously, they're part of consumer staples because majority of their revenue come from cigarette, and that cigarette is a part of consumer staples. You know? This is what I already told you. Industry grouping may be either too wide or too narrow. I give you the example of t-shirt. If a company is selling multiple products, you try to see where the majority of the revenues are coming from. Now, guys, a cigarette company in India cannot be compared with a cigarette company in the US, maybe, right? Because the tax structure could be very, very different. The demographic could be very, very different. So as a result, even you may further divide the industry based on geography. कि India का cigarette business is different from US का cigarette business. So this is one way that you group the companies based on the business they are doing. And this is like the most logical, intuitive, reasonable way to classify the companies. Other ways you can classify the companies by geography. Indian companies versus US companies. I don't care about what business they are into. You can divide the companies based on cyclical versus non-cyclical. I don't care about, so like HUL and also Apollo Hospital and also Byju's. They will all be part of the same category called non-cyclical. But are they in the same sector? No. But my classification is not based on the services being provided. It's completely based on whether it's cyclical or non-cyclical. So non-cyclical will include all the healthcare companies, all the education companies, all the FMCG companies. But cyclical will include the companies which are into metals and mining, automobiles, real estate, and so on. So my classification is not based on the goods and the services, but it's based on whether it's non-cyclical or cyclical. Sorry guys, I keep saying it non-cyclical, but it's also called as defensive company. We can classify the companies based on the financial measures like the growth, the valuation, the company's sales, the size of the company, and you can also look at the ESG. The second component, if you remember, was industry size, like what's the size of the industry. Now, you can look at the, let's say industry size ki baat karte, right? So if I ask you what is the total industry size for smartphones, if you do the total sales of Samsung, if you do the sales of Apple, if you do the sales of Oppo, OnePlus, and all of it, if you combine it, will it be equal to the total size of the industry? Maybe not. Because there are lots of unorganized players in the market, right? Smartphones के case में it's very limited, but guys, if you talk about a product like FMCG, there are lots of unorganized products in the market. So in this case, the industry size can be very different from the revenues of all the companies combined. So this is the first part. Total annual sales of the product, which is not always the same as total annual sales of the companies in the industry, because some of the companies included in the industry operate in multiple product lines. तो अगर तुम स्मार्टफोन की बात कर रहे हो, and if you take the Apple का revenues, Apple is just not into smartphones. They are also providing other services, right? तुमने Samsung ले लिया, but Samsung is just not into mobile. They do so many other things. And you could not take the smartphone ka volumes from one of the local supplier who make their own iPhone and sell it in the market. So you'll miss something, you will overcount something. As a result, you cannot just combine the revenues of all the companies to get the size of the industry. Some industries can be growth industries or mature industries. Can you tell me like which are the growth industries in case of India's context?
EV.
Very good. Yeah, electric vehicles, they are like growing quite a lot. And the way like all the electric vehicle companies are talking about it, like they have a growth estimate of like 30%, 35%, 40% every year. And this is how they've grown as well. That's very good. EV companies are the growth industry. So if you are into electric vehicle, anything to do with electric vehicle, that's going to grow. So even if your product is not that great, because you're in the right industry at the right time, you should do good. So when I go to Shark Tank, I'm not surprised that there's so many people who are coming with the products which is about electrification. What else? Any other example of a growth industry?
Solar energy,
Solar energy, renewable energy, hydro
renewable
energy,
energy. Yep.
anything to do with waste management, recyclability of it. These are all growth industries. What are the industries which are mature industries?
Petrochemicals.
Yeah, fully agree. Petrochemicals, yeah, but maybe like on the petrochemicals, I'll go on the other side. They're mature and they're towards they're going to die down. धीरे धीरे कम होते जा रहे हैं वो industries. So guys, some industry can just mature and stay there, but some industry mature and they start declining and they go away. The example I give is generally about the film photography, right? वो reel वाले जो cameras आते थे, Kodak cameras, right, and all. Now, if you take photography as an industry, that's obviously there and that's going to keep growing, right? But if you take a very narrow definition of film photography, that went up, that matured, that has died down, and that's out of the market now. That's not an industry anymore. But some industries can mature there. Maybe I would say the garments is a mature industry. इसमें क्या innovation हो रहा है मतलब? The collar का shape मतलब there are 10 different types of collars you can get, right? Chinese collar, this collar, that collar. But guys, just give me 10 seconds, okay? So when there's no innovation happening, when there's nothing new happening in the industry, when the volumes are not growing that much, we call it a mature industry. If you take a branded clothes, that's a growing industry. Because of the urbanization, people will go towards brand. But if you take the overall ready-made garments as an industry, that's a mature industry. Cyclical versus non-cyclical, we have discussed a lot about it. So I'm not going to spend more time on it. Industry profitability, some industries are highly profitable. जैसे इंडिया के केस में बोलते हैं like some industries can never make profit in India. Do you know which are those notorious industries which can never make money or which have not made
Airlines.
money? Yes, airlines always comes at the top of the list. कुछ भी हो मतलब airlines तो कभी पैसा बना ही नहीं पाएगी. So Indigo and SpiceJet are in that category. What is another industry? Telecom is another. इनका fixed expenses इतना ज्यादा होता है like to have the network and to have the towers and everything. And ऊपर से regulations are try के difficult. Airlines के लिए bumper year होने वाला था 2020 and 21, right? They could have made lots of money in 2021, right? When people started traveling. And there was a concept of revenge travel. Have you heard about this revenge travel? It became very popular in 2021 and 22.
Yes, sir.
Anyone?
Yes, sir.
What is revenge travel?
It's more like FOMO, they missed out on traveling.
हाँ तो तुमने मुझे ट्रैवल नहीं करने दिया 2020 के अंदर अब देखो मैं कितना ट्रैवल करके दिखाता हूँ तुम्हें so your parents say like don't eat chocolate अच्छा तुमने मना किया I'll eat more chocolate now so in this case like 2021 and 2022 would have been the golden years for the air industry right first of all they could charge you whatever they wanted to right and you had lots of savings done right because you were not traveling in 2020 so people purchasing power was very high and people not thinking about money like all of a sudden India which is like more of a saving economy became a consumption economy क्योंकि लोगों का जिंदगी से विश्वास उठ गया टेक्निकली, राइट? कि पता नहीं जिएंगे या नहीं जिएंगे, कम से कम मजे तो कर लो, राइट? बट व्हाट हैपेंड? कुड दे मेक मनी इन 2021-22? नो, दे कुडंट. क्यों? कैप लगा दिया गवर्नमेंट ने. For a long sector, you cannot charge more than 5,000 rupees. And for a short sector, you cannot charge more than 2,500 rupees. You remember, right? You know, right? All these things. So not that the cost and the airline wanted to charge less. They wanted to charge you a lot more. But even if they wanted, they couldn't. और 2 साल बाद गवर्नमेंट ने रेस्ट्रिक्शन हटाया, तब तक ये रिवेंज ट्रैवल जो फॉर्म है वो खत्म हो गया लोगों का. So guys, some industries they can make more profit, some industries can't. When we talk about market share, we look at things called HHI and what is the share of top 4 companies in the market. Top 4, top 3, top 5, there are different things people look at. But let's say if I'm looking at top 5, let's say there's an industry where the top 5 players have a 90% market share. It means what? It's highly concentrated industry. इसका मतलब there are few large players who control the entire market. But if I tell you that the top 5 is only 20%, they're like 3, 4 big players, but still it's a very, very segregated market. And if I tell you that the top 5 has only 1%, it's a highly segregated industry. Even the largest player has only 0.5% market share. The example could be medicine stores. Example could be vegetable stores. Example could be grocery stores, right? Another thing what people do is they do HHI. H for Hirschman, another H for Herfindahl. There are 2 different people, Hirschman, Herfindahl, and they came out with an index, which is what we call as HHI index. So in this index, what happens is, let's say there's an industry where the largest player has a 30% market share. The second largest player has a 20% market share. The third largest has 15. The 2 play with 10% market share. And there are other 15 players with 1% market share each. So those in percentage, guys, I'm not putting percentage here, but if I do the total, I'll get 100. So what HHI index does is, HHI index takes the square of all the numbers and look at the total of the squares. If the total of the squares is between 1500 to 2500, it means the industry is concentrated but not that concentrated. It's like moderate. If it's less than 1500, it means industry is highly segregated. If the number is more than 2500, it means industry is highly concentrated. I'll do the math and show you. So in this case, let's say this number is 1740. It means, yeah, there are like some large players, but there are also some small players. But think about the top player was 40, the second player is 30, the third player is 10, and there are lots of other players with 3% market share each. Oh, sorry, थोड़ा ज़्यादा हो गया. So see, the score goes to 2650. It means the industry is highly concentrated. But if I tell you that the top player has only 5% market share, the second largest has 4% market share, the third largest has 3% market share, and there are many other players who have got 3% market share each. But to make it 100, I have to put more numbers. So let's make it 7 each. Let's make it 5 each. Now see the score is only 564. It means it's highly segregated industry. Why do I look at it, guys? So if the industry is highly segregated, and let's say this is company P, company A, and company B, they want to merge together. तो merger के पहले क्या था? This is the thing before merger, pre-merger. The regulators will see, अच्छा, अगर merger हो गया, तो what will be the situation post-merger? Post-merger के बाद, there will not be 2 companies of 7% each. There will be only 1 company with a 40%. This company will become 0. The total market share remains 100. But now my total score has gone up from 564 to 662. It means industry has become more concentrated. But ठीक है, पहली बात तो industry initially was highly segregated and the concentration has gone up only from 564 to 662. Government will say, अच्छा कर लो. If you want to merge, get merged. No problem. But take another example. The top player is 40%, second player is 30%, and there are many other players with some market share. So see the industry concentration currently, it's very, very high, right? And let's say A and B wants to merge together. If A and B wants to merge together, this will become 70, this will become 0. So पहले तो industry is already concentrated, and because of this acquisition, see the increase in the concentration ratio. So regulators will say, hey, sorry, we cannot allow this merger to happen because you will kind of create a monopoly. And when you create a monopoly, it's not good for the customers. So guys, HHI index is something what the regulators will see to understand whether the particular merger or acquisition should be allowed or they should not be allowed. So I generally think that, if Pepsi and Coke merge together, trust me guys, we'll lose sleep. Abhi, if you try to think revenue for them for a 300 ml bottle, revenue, they charge you 20 rupees. If you think about the cost of these thing, right? The cost of the material, the cost of the bottle, how much it is?
Maybe close to 1 rupee or 2 rupee.
1 rupee of the material and 1 rupee for the packaging and the bottle and everything combined.
Right.
Maybe logistic cost, like to get it like in the cold storage and get it delivered to you, a shop nearby, that's another 1 rupee. Maybe the commission what they pay to the wholesaler and the retailers, that could be another 2 rupees. They're not going to give lots of commission because a retailer doesn't have to sell these things. A customer will buy these things automatically, right? So there's no push required from the retailer. Oh, by the way, they spend lots of money on advertisement and marketing. And maybe they spend like almost 10 rupees. So eventually the profit they make is very, very less. Maybe like 5 rupees on selling a bottle worth 20 rupees. But if they merge together, guys, try to think what will happen to the profit if they merge together. Abhi, none of them are increasing the price because if they increase the price, people may shift to another brand. If Pepsi increases, they shift to Coke, and if Coke increases, they will shift to Pepsi. Or some of you might be loyal. I am not loyal to the cold drinks, right? If somebody charge me 25 rupees, I'll go to the one which is charging me 20 rupees. For me, Coke is Coke, whether it's Pepsi or Coca-Cola, right? So in this case, if both of them merge together, they'll charge you 30 rupees. And trust me, you won't mind. 20 rupees pay karo, theek hai, 30 maybe you mind, 25 to for sure you won't mind. Because both of them have merged together, they'll get economies of scale. Their cost may not be 2, their cost may be 1.5. They'll save a lot on logistics. They don't have to have two different trucks going to the same store, right? अभी क्या होता है, रिटेल शॉप के ऊपर एक कोको कोला का ट्रक आ रहा है, एक पेप्सी का ट्रक आ रहा है, एक कोको कोला का फ्रिज है, एक पेप्सी का फ्रिज है, right? Those things will not be there. Logistics will come down quite a lot. The commission what you pay to the retailer, you'll say, dude, if you don't want to sell, don't sell, right? I'm going to give you only 1 rupee commission. And advertisement marketing करनी क्यों है? The reason Pepsi was doing marketing is just to compete with Coke, and the reason Coke was doing marketing is to compete with Pepsi. And Pepsi and Coca-Cola must be dreaming every day, "Arey yaar, what if we could merge together?" But you know what? They won't be allowed because of HHI index. The HHI index for cold drink sector is very high, and if they merge together, it will create lots of problem for the customers. As a result, it won't be allowed. सोचो अगर Airtel and Reliance Jio merges together. Currently, you're paying 300 rupees, 400 rupees for your postpaid. they charge you 1,000 rupees for your postpaid connection. क्या करोगे तुम? You'll still pay, right? But don't worry, guys. HHI index will take care of it. Given the HHI index is very high, and they are the top two players. अगर इसके अंदर अगर let's say the industry is highly concentrated, but let's say these two players wants to merge together. Government will say, "ले, कर लो, you merge. We don't care about it. If you merge together, this will become 2, this will become 0. The total HHI score will increase only by 2 units. Not a problem at all. But these two companies, no, they can't merge together. Porter's 5 forces, guys, we have discussed it before. See, this is again coming up. And I'm not going to talk about it because I discussed a lot about it. We discussed about Porter's 5 forces, right?
Yes, sir.
Pastel, I just touched upon it. Political, P for political, E for economical, S for social. Now, guys, social part is very, very subjective. Like, in one country, what is a social positive can be a bad thing in the other country. Just for example, I would tell you, let's say drinking. In India is a taboo. You accept it or not, right? And if you are into a business which is related to liquor, it slightly have a social negative impact. But trust me, if you go outside India and if you go to, let's say, US and maybe UK, there's no negative view just because of alcohol thing, right? uh यहाँ पे अभी everybody's talking about influencers. So one of my cousins is like, launching his own product. So I said like, okay, how will you do the marketing? He said, he has robbed in an Instagram personality who has got like, I think, a couple of million followers. And just like this Instagram personality will put some post about that particular product. And how will they put a post? She will be just like talking about something else, about her new uh, something. And while talking, like, that particular product will be kept on her table. That's it. So people will see, and will feel like, this celebrity is consuming this product. And so she's not making any video for my cousin. She's not creating any content for my cousin. She's just putting her regular content. But while putting her regular content, she will put that particular product of my cousin in the camera, in the camera view. So this entire video, what she's generally putting is generally a 2-minute reel. In this case, in that 2-minute reel, for 30 seconds, that product will be visible. As a result, she's charging 3 lakh rupees. If you want it to be on for 1 week, if you want it to be for a full month, you pay 10 lakh rupees. Okay, technology. We discussed all about it, guys. Now the point is that, disruptive innovations, or disruptive innovation means like something which is coming from a new entrant to industry altogether, right? Tesla is a disruptive innovation. Legal, like tobacco is also political but is also legal. Liquor is also social but is also legal. Now, what is the company's strategy? Is the company trying to compete with the market because they want to beat the other companies using cost? Like, this is what DMart is doing. And if you're being to DMart, if you're looking for a shopping experience, never go to DMart. But if you're looking for a budget buying, guys, they are the only ones who can compete with the Amazon of the world and the Flipkarts of the world. So let's say, this Nivea cream we buy. Oh, it's lying right there. So this particular product we buy, right? No marketing here, but this Nivea product, the MRP here is what, and I was surprised, this is like very recent, and that's the reason I remember. I don't know the MRP, but I think it's 250 or 270. Oh, sorry, I'm so outdated. It's 465, the MRP. But if on Amazon, it will be available at. So if you go to any grocery store, like a small grocery store, and if you want to buy this particular product, पहली बात तो expired मिलेगा क्योंकि nobody has bought it from their shelf. If you're lucky, you'll buy a proper product in a proper packaging, and they will say, okay, pay me 465 rupees. They'll try to negotiate. They'll say, अरे sir, बचता ही नहीं है कुछ भी, and say, okay, ठीक है, it's you, so I'll make it 460. ठीक है? You go to Amazon, this will be available at 350. You go to DMart, it's available at 280. So the reason DMart is able to survive, they're able to compete. Are they selling anything different? No. Are they providing you a shopping experience? No. It's just cost leadership. They make so much of churn, and they're not selling it at a loss. So technically, what's happening is when Amazon have a deal with Nivea, that hey, we will sell these many products of yours. What is the lowest price you can pay us? Supply this product for. Versus DMart doing it. DMart is having a lot more volumes than Amazon, and they're able to compete with Amazon. And guys, if you're not been to DMart, just go to DMart once. It's a different thing altogether. Everything and anything you'll find a 10% discount. I've never been there. I didn't have the guts, but my wife has been there a couple of times, and she tells me. But as a economics student, you must visit DMart once. It'll tell you the concept of economies of scale. It'll tell you the concept of cost leadership strategy. But many times the way you differentiate, the way you compete in the market is you just differentiate your product. जैसे fog DO आया था, right? अरे DO ही है, but चलता ही रहेगा. The number of puffs you get is just too many. That was a differentiation strategy. Kinder Joy. Oh my God, I just like feel bad. Every time I talk about Kinder Joy, मुझे लग रहा है कि half of my salary goes into Kinder Joy. So recently, like I knew it's an expensive one, and I wanted to buy for both of my kids. So I took 50 rupees out and gave it to the shopkeeper. कि भैया 2 Kinder Joy देना. And it turns out कि it's so expensive कि in 50 you just get one. It's 50 rupees का abhi. So the last time I ate it, it was like 20 rupees. So one thing is expensive, and it has become a lot more expensive now. 50 rupees. Oh my God. Any which ways. So the way Kinder Joy is doing, are they leading on cost? No, they have a different product altogether. Differentiation strategy. क्यों? चॉकलेट नहीं, चॉकलेट के साथ टॉय भी है. चॉकलेट 2 रुपए की है, टॉय 2 रुपए का है, बट चॉकलेट रुपए की है. The combination is 50 bucks. And my kids are crazy about it. I tell them, okay, I'll get you Dairy Milk. No. I'll get you Kit Kat. No. Kinder Joy चाहिए. क्यों? वो टॉय आएगा उसके साथ. Very nice, and that's working, guys, right? Think about the margin they must be making on that. Your strategy could be focus strategy. You just like become so focused, so niche. Like the best example I can provide you is like within Bangalore, there's a store and they only have triple XL size and above. Not even double X, only triple XL and above. Like very, very focused. कौन compete करेगा उनके साथ बताओ? Nobody can compete with them. मतलब Amazon पे जाके, like if I tried doing it, put a filter with triple XL, more than double XL. Out of 1,000, there'll be only 2 products available. That's it. And this entire store is with everything which is triple XL and plus. Ferrari itself is a focus strategy, right? They're not targeting you and me. They're targeting like, just like top 10,000 people in the world. So guys, you can read about it, like how the forces are, and it's just like a very interesting read. Like you don't have to remember anything. Let's do some questions on this, okay? Because now like we are going towards more, oh sorry. Which reading where the questions are? Give me 1 second, guys, so that I don't reveal the answers. Okay, 46.1. Let's do a couple of questions from here. Question number 1. Please put your answers in the chat window. I got response from 4 of you. So I got only out of this, like 4 of them are correct. So Smita has got it right, Pawan has got it right, Nandini has got it right, Rishabh has got it right. So here, guys, the answer is products and services. So what we are saying is that the industry classification one is JIX, but the other classification is being provided by. Sorry, 1 second. Who's there? So whether it's JIX or the other couple of ones, right, who provide the classification, both of them and all of them provide the classification based on products and services. There's no institute who provides it by statistical methods or the business cycle sensitivity. Yes, there's a classification possible, which is cyclical versus non-cyclical, but there's no institute who gives that classification. So the answer choice is B. Question number 2, firms and industries are most appropriately classified as cyclical or non-cyclical industry based on. Okay, second also is B. It's a bit tricky, right? C cannot be the answer. It's not versus competitors. Now A and B both can be the answers because they fluctuate more than the market. The share price fluctuate more than the market, and the earnings are also more sensitive to the business cycle. Because business cycle is nothing but the market, and earnings will translate into stock price. But guys, the cause and the effect. The reason the earnings are more volatile, the stock prices fluctuate more. So the core reason is B. I won't say A is wrong, but B is a better answer. And C is not an answer at all because the comparison is never with the competitors, the comparison is with the broader market. Okay? Let's do the question from 46.2. Another 5 minutes, guys, and then we'll call it off. Question number 1. Okay, so here C is not the answer because we never discussed about regulators as a part of it. Regulators to some extent will come in your pestle analysis when we talk about legal and the political part. यहाँ पे A looks correct, threat of entry, but the thing is barriers to exit was never a different force altogether. Many times people put barriers to exit as a part of threat of entry itself. You guys, one thing is to enter the market, the other thing is to exit the market. If it's very difficult for people to exit the market, जैसे restaurant business में it's very difficult for people to exit the market क्योंकि इन्होंने cost तो लगा दिया अपना, 1 साल का एग्रीमेंट भी साइन कर लिया, रेंटल भी दे दिया, फर्नीचर भी लगा लिया है। अभी लोगों को क्या लगता है यार कि धंधा हो नहीं रहा है, बिजनेस हो नहीं रहा है, and that happened with a friend of mine, right? He's not making profit, but is he shutting down his restaurant? No, he's just wishful कि कभी तो turn around होगा, कभी तो लोग आएंगे. Now the problem is that not that he's making losses, but he is causing problem for others as well. How is he causing problem for others? हर दिन ये कुछ ना कुछ नया डिस्काउंट देता रहता है मेरा फ्रेंड, तो technically it's impacting the competitors as well, right? Because he's not vacating his shop, the rentals are not going down in that area. Because he has hired a cook and a server, the cost of these people have still remained high in the market. So if he shut down his shop, the supply of cook will be more, the supply of servers will be more, the supply of shop will be more, and it'll become easier for the other competitors in the market. But guys, they are not two different things. They are part of entry and exit. So as a result, A is wrong. C तो पक्का सी गलत है क्योंकि पावर ऑफ रेगुलेटर्स उसके अंदर है ही नहीं है कोई. There is no discussion about it. So the correct answer choice is B. Question number 2. Surprisingly, here I got lots of wrong answers. Many people have said A क्योंकि उन्होंने volume देख लिया यहाँ पे word बस. And this is the trick like the CFA can play on you. So cost leadership is just not about volumes, guys, right? The focus is on reducing the cost. You want to be the lowest cost producer. And if you want to be the lowest cost producer in the market, it's not about how much the volume range can be. It can be modest to high. That's not the thing. You will give lots of incentives to promote efficiency. क्योंकि एक बार efficiency आएगा economic company के अंदर, cost will come down automatically, and you'll become the lowest cost producer in the company. So in one of organizations I've heard, like if you go and submit a proposal which can save the cost to the company, whatever cost the company can save after implementing that change, you'll get 10% of it as a form of in the form of bonus. And your suggestion can be as small as, hey, we don't need 3 different printers, we just need 2 printers. We don't need like 3 staff in the coffee machine room, we just need 2 staff. These kind of suggestion you keep giving, they'll see that it does not reduce the employability and it does not reduce the comfort for employees. And without doing that, if they can increase the save cost. So these are the things the company will do if they want to focus on the cost part. So answer here would be B. If the success depends heavily on investments in customer service and all, means your strategies may be product differentiation. Right? Then that's the point of time, right? You'll focus on how the customers perceive your product, how you can distribute it, how you can differentiate your product, and so on. So C sounds like more of a product differentiation strategy. A, I don't know, it's nothing to do with either of the strategy. And B sounds like the cost leadership strategy. Okay. So that's mostly about it, guys. I'll roll out a feedback form, but yeah, feel free to log off after filling the feedback form. But if you got any question, I'm here and happy to discuss.
Yeah, Ansh, quick question.
Yep.
Regarding this preference shares, right? Convertible preference and preference shares, how they can be purchased? So they can be before coming into the secondary market, right? So where that can be
No.
trade is
Even in the
those are
second,
tradable.
कुछ preference shares मतलब नहीं होते trade, but there are some preference shares which are also traded in the market. But
Okay.
generally preference shares are like, at the time of issuance only you apply for it, and the
Okay.
markets are not that liquid because the number of preference shares are very, very limited.
So at the
So
time of IPO itself, those can be included. So these
हाँ,
are set of
उसका
preference
IPO
shares or
टाइप भी नहीं
something.
होता, उसका मतलब more of like होता है ना private issuance वगैरह होता है.
Okay.
So to be honest, it's not that active public market.
Mm-hmm.
कुछ preference shares listed है, but there are not too many of them.
Okay. Yeah. Thank you.
Thank you, sir.
Cool.
Okay. Thank you,
Okay,
Ansh.
guys. Yeah,
Yeah.
bye bye. Thank you. Bye
Bye.
bye.
Thank you.